It's an absolute joy to welcome you all to this special session on the Integrated Business Solutions paper brought to you by Board of Studies Academic. We truly appreciate your taking the time to be here today. Unlike conventional subjects that focus primarily on rules, standards, or calculations, the IBS paper invites you to think beyond the silos of theory and dive into the real dynamics of business where finance, strategy, operations, compliance, law, and taxation intersects. Let us take a simple example. Okay. Imagine a listed healthcare company planning to expand its operation by setting up a multi specialty hospital in a tier 2 city. At first glance, this appears to be a strategic business decision intended at meeting growing healthcare demand, improving accessibility, and specialty care. However, such a decision is not taken in isolation. It is deeply interwoven with a complex web of regulatory, financial, taxation, and accounting considerations. Since the company is listed under SEBI's LODR regulations, any major capital investment, public private partnership, or acquisition of hospital land assets must be promptly disclosed to stock exchange. Transparency in financing arrangements and board level decisions is critical to maintain investor confidence and regulatory compliances. From a direct tax perspective, setting up and operating a hospital qualifies as a business activity, and the company may explore deduction under Section 3580 for capital expenditure on specified healthcare facilities. Tax planning must also consider depreciation on medical equipment, TDS on payments to consultants, and the impact of MAT provisions, especially where tax holidays or incentives under state policies are involved. On the indirect tax front, GST front, the healthcare sector is partially exempt, while services provided by some clinical establishment may not attract for GST. Input tax credit on capital goods like MRI scanners, ICU beds, diagnostics equipments used for exempt services may be blocked. Hence, a detailed ITC strategy is required to optimize cost while ensuring compliances with GST rules. From a financial management perspective, the project involves large scale of capital deployment, land acquisition, construction of hospital infrastructure, procurement of medical technology, construction of hospital infrastructure, procurement of medical technology, and working capital for skill staffing. The company must conduct capital budgeting, finance options such as terms loans, equity funding, or external commercial borrowings if imported medical equipment is involved. In the case of ECBs or FDI in healthcare, FEMA and RBI guidelines must be strictly followed to avoid regulatory hurdles. In terms of accounting and reporting, if the hospital uses equipment under lease, the company must apply Ind AS 116 lease, properly recognizing right of use assets and related liabilities. Ind AS 38 intangible assets may apply to hospital management software or proprietary health apps, while Ind AS 115 revenue recognition governs how income from consultation, diagnostics, surgeries, or wellness program is recorded. Operationally, the hospital may enter into MOUs with insurance provider partner with pharmaceutical companies or explore telemedicine services to enhance patient access. Each of these business decision involves strategic analysis of supply chain logistics, transfer pricing, and data privacy compliances. In short, is a seamless, straightforward expansion in the healthcare sector demands integrated knowledge. Okay, integrated knowledge across taxation, law, audit, accounting standards, strategic financial management, and risk management is very important. It is very, very important. It's a classic example of how ICAI's IBS paper trains students to connect dots across subjects and arrive at strategic, regulatory compliant, and commercially viable decisions. In our previous sessions, we examined real life companies from fast fashion, aviation, FMCG, tea, and transportation, each, each illustrating how business strategy, regulatory compliances, and financial performance are closely related. Today, we bring you an interesting case study from the Case Study Digest. We are pleased to inform you that Volume 2 of the Case Study Digest has just been released. This edition features a range of real life industry relevant case studies carefully curated to enhance your understanding and application of multidisciplinary concepts. We encourage you to go through the Case Study Digest thoroughly. Your feedback and suggestions are most welcome and will help us continue improving these resources for your benefit. The Max Plus is case study. The Max is case study set in the medical sector offers a multidisciplinary scenario that integrates key concepts across accounting, taxation, and financial management. It covers application of IND AS 116 for lease medical equipment, treatment of input tax credit attributable to taxable supplies in a partially exempt situation, and computation of assessable value for imported machines under indirect tax laws. The case also explores foreign exchange risk management by comparing forward contract call options and money market hedge. Additionally, it touches upon IND AS 1 and IND AS 8 for proper financial presentation and consistency in accounting policies, offering students practical exposure to real world decision making in the healthcare industry. All the case study material are available on the student portal, and I encourage you to review them carefully. Today's session will be interactive, so feel free to ask questions whether in English or in Hindi. You can either speak up or type your query in chat box. Additionally, the last 15 minutes will be reserved for general questions that may not be directly related to your case study. We are lucky to have with us today CA Susanna Balaji, a prominent chartered accountant with outstanding experience in conducting statutory audits for large organizations. Her expertise will help you connect theoretical knowledge with practical business scenarios. With that, let us begin today's session and explore this insightful business case study. CA Susanna Balaji, over to you.
Hi. Am I audible?
Yes, ma'am.
I'll just quickly share my screen also. Just a second. So you can see my screen, right? Fantastic. Okay. So a very good evening. I am Sujna Balaji. I'm a practicing chartered accountant and I have close to 7 years of post-qualification experience. I have done many assurance engagements and also consultancy engagements. So that's where I think my expertise will come in helping you understand this case study. So with that said, we'll quickly jump into this. So, like I think Sir had already explained, this case explores multiple different avenues, including India's accounting, a bit of GST, a bit of customs valuation. We will also have to explore multiple options under the financial SFM, where you will be looking at multiple forward covers, money market, and other option to see which is the best solution available. And then we'll also be looking at some presentation. We'll also be looking at the customer lifetime value in this given scenario. So there are multiple very interesting aspects in this case study. So I request that you take some time. We will read this case study together once. And there could be very small elements which could be very useful when we're actually solving the problem. So I request you to please pay attention. There could be very small aspects. There are 100 cities with 10 stores in each city. There could be a very small piece of information, but then it's very critical when you apply it later. So please, when I approach the case study, what I used to do when I was a student is I used to mark all these out. So, or at least write these down. So it will come in handy when I'm actually taking the decision, because it's very difficult to go read the entire case study whenever you solve the problem again. So that's something that, I thought I should share. So with that, we'll quickly get to the case study. So yes, we will read it together once, and then we will look at the problems. And after which there'll be a short break, and then we will take the next case study for the evening. Okay. So Max Plus, which should be referred as a company, is one of the most trusted gateways for medicines. It's incorporated in Delhi. It has an aim to eliminate fake and ineffective medicines and supply good quality medicines in India. So that is the objective. According to WHO research, every 1 or 2 medicines out of 10 medicines are adulterated in the low and medium income countries like India. Consequently, the company aspires to bring in about a change in these statistics. To improve transparency in the function of the pharmaceutical industry, the company has been successfully contributing to providing genuine and unadulterated medicine since its incorporation. Very important. Also, as market demands, a constant customer loyalty program is being introduced by the company. We will talk about it a little later in the case. So they have a customer loyalty program wherein eligible purchases customer can avail cash discounts or enjoy incentives which can be converted into, testing apparatus or scented floor cleaners, etc. The entire operations are broadly classified into 2 different divisions. One is the retail division, the other is the agency division. So we'll now be looking at the retail outlet division, right? So as far as the retail outlet division is concerned, currently the chain of medical store operates in 100 cities in India with 10 stores in each city, right? As per the accepted policy of the company, it does not involve a franchise model, and all the outlets are operated by the company directly. Okay. It does not involve a franchise model. All the outlets are directly operated by the company. Also, as per its policy, it does not operate its outlet from owned premises, and all are rented properties. This is also very important, that there are no owned premises, only rented premises, which are all under the lease model. So the stock and sales are accounted and managed through a customized and specialized software developed by the company 2 years ago. It has various inbuilt features like stock at glance, outlet-wise sales, frequency of customer purchases. These are all, things that the software is able to record. The IS officer of the company is a certified professional. The customer database is protected in all respects. The information security officer. With regard to its outlets, the company, through its legal wing, enters into a 3-year lease agreement with its landlord for operating its stores in all cities. The company enters into a 3-year lease agreement with the landlords for operating its stores in all the cities. Right? As part of the vendor registration, the company captures all details of landlords like PAN, TDS, MSME registration, GST numbers, type of building, onus of payment, electricity, on all this information at the time of entering into the lease contract, incorporating this into, incorporating the incorporation of escalation clause for rental value. According to the vendor database maintained by the company, out of the 100 landlords, only 50 are registered in the GST law and raised GST invoices. The remaining 50 are unregistered. 10 landlords are registered under the MSME Act, and all the lease contracts stipulate that the lessor will perform maintenance of the lease premises and receive consideration only for that maintenance service. It's also important that the lease contract stipulates that the lessor will be the one who is responsible for maintenance, and then he will receive consideration for the maintenance service. So I'm going to give you the terms of the lease contract. The company is capable of selecting very similar places in different cities having similar rents. The company is also capable of finalizing the lease contracts with similar terms and conditions. So what is essentially they're trying to say is all the contracts will have a similar lease rent with similar terms with similar lease periods also. The contract includes the following fixed monthly payable at the end of every year for lease and non-lease component. So you will pay 27,000 and 3,000. Standalone prices are 28,000 and 15,000. So these are fixed monthly prices which are payable at the end of each year. So it's very important that you have that these are payable at the end of the year. But these are fixed monthly prices. And they are also giving you a segregation of the lease and the non-lease component as 27,000 rupees as the lease and non-lease component, which is maintenance, at 3,000 rupees. So the non-lease component usually would generally refer to, cleaning services, housekeeping services, security services. So these are non-lease components. India specifically gives you a practical expedient also, which we will talk through when we are solving the case. But this is a very important aspect for you to note. The standalone prices of readily observable lease and non-lease components are the total is 30,000, but the lease will be 28,500 and the maintenance will be 1,500. Right? So Max Plus, which is the company, has opted the practical expedient provided to the lessee for the accounting purpose. We will also see when we are solving the problem what this practical expedient is. The company has the ability to forecast demand for its product with high accuracy, and it has sufficient working capital requirements. Demand is continuous, hence if inventory turnover is high, the profit margin earned generates sufficient cash flow, the working capital needs are sufficiently met by internal reserves. All these factors enable the company to sell its product on a large scale in anticipation of the demand. Inventory can be stocked up and sold when the demand arises. So this is on the retail division. I think what we can quickly go and do. Okay, maybe we'll discuss the entire query and then we will come back to this. Let's discuss the entire case because there could be some overlapping elements. So this is on the retail division. Next is the agency division. The agency division, the company is also a leading dealer of extensive medical equipments. Max Plus directs all its activities to cater to the expectation of customers by providing them excellent quality products as per their gratifications. On the basis of its quality principles, it's been able to serve its customers honestly. The retail division, the company regularly purchases different types of medicines through centralized procurement system. These are distributed at the outlets, which are sold to the customer. Unsold are held as stock in hand. However, as far as medical equipments are concerned, they only buy the order when the customer gives the purchase order along with the product specifications. So there's a clear distinction between retail outlet and the agency division in terms of how they are managing their inventory. In one case, they stock up. In the other case, they only procure when the customer gives an order. So during the financial year, they have imported a CT scan machine. They are going to give it to the hospital. The hospital is registered under 12 AB of the Income Tax Act. They're involved into healthcare services. So the price at the exporter's factory is $8,500. The freight will be $250. The freight from the factory to the airport will be $250 in the country of the export. The loading and handling charges at the airport will be $250, which is at the load airport, the export, before the export happens. The freight for the load up to the point of importation in India is $4,500 and the insurance is $2,000. Though the aircraft arrived on 22nd August, the bill of entry for home consumption was presented on 20th August 2023. The chief tax officer of the company is uncertain about the consumption of assessable value of the CT machine, needs clarity on what will be the basic customs duty rate and what will be the exchange rate. Will it be on the date of arrival of the aircraft, which is 22nd August, or will it be the date of presentation of the bill of entry, which is 20th August? And he also wants to know what is the rate of exchange that should be applied. Should it be the CBIC rate? Should it be the rates prescribed by RBI? On which date? Should it be on the 22nd? Should it be on the 20th? That is also something that he wants to know. It's very important to note that the basic customs duty as on 20th was 20%. However, on 21st, the newly elected government reduced the rate of basic customs duty to 10%. So the relevant details for you are furnished: the exchange rate by CBSE, the exchange rate by RBI, the IGST leviable under these two dates are also given. For import of the aforesaid mentioned, the company is liable to settle the exporter in 3 months. So the time of import, the company is entered into a forward contract to hedge. However, they have also not considered other hedging alternatives like option contracts or money margin hedging opportunities which are available at that time. So what he's giving, the information that's given to you is, just a second, so sorry. The spot rate, they will buy at 80.23, they will sell USDs at 80.98. That is the spot rate. The interest rate in India is 10%. The interest rate in USA is 4%. All these are given at a per annum level. The actual, see, very important to note that they're saying the actual forward rates commensurate with the theoretical forward rates. So at the time of entering into the forward contract, the bank also charges a margin of 0.5% on buying and selling. So very important that he's essentially saying that the interest rate parity will hold. There is no arbitrage opportunity. So that's why he's saying the actual forward rates commensurate with the theoretical forward rates. Right? Okay. Then he's also telling you for the option, the strike price of 81.21 with a premium of 1.5 is also given. And then they're also giving you a particulars of another well outlet, where they're saying this is an outlet which is located in a town with many colleges and universities, which has a lot of student population. Many of them are health conscious. They're regular buyers of health products. Business for these particular outlet has been slow due to the advent of online pharmacies, which offer convenience, discounts, and time-saving benefits. So business has been slow due to the advent of online pharmacies, which give you a lot of, incentives, discounts, and time-saving benefits. However, the management believes that students will still prefer personal service, immediate availability, and expert advice that only a physical pharmacy can offer. So management has framed a plan to attract students by offering health discounts. By discounts on health products. So they're also giving you some information metrics on how many years a student spends in the university, which is 4 years. For a nominal one-time subscription fee, they offer discounts for the 4-year period. By attracting more footfalls, they're able to cross-sell their wellness products and health supplements. So apart from the health products, they're also able to sell wellness products and health supplements, which they believe that will help them sustain their revenue for each year. They also thought by initially offering free health checkups, wellness product, gift vouchers, they'll be able to attract attention. This is a one-time expense. This free health checkup, free wellness products, and free gift vouchers are the initial one-time expense. Net of the one-time subscription fee that is mentioned above. Here we saw that there's a subscription fee, which also, there is an income and then there is an expense. So the net expense cost would be rupees 5,000 per student. So they're saying the total cost that they incur for these free health checkups, wellness products, and gift vouchers, net of the subscription fee would be 5,000 rupees per student. And on the subscription or to the plan, the purchases that they expend or spend on health products, spend on wellness products, and spend on health supplements are given. They've also given you some assumptions, which we will probably come to. They're saying only 50% of the subscribers are expected to visit the pharmacy in years 3 and 4. Across the years, only 75% of the subscribers who visit are expected to buy wellness products, and only 25% of the subscribers who visit are expected to buy health supplements in year 1 and 2, and 10% in 3 and 4. So these are some metrics which are given to enable you to compute the customer lifetime value. So now with that, let's go to the questions, right? Okay. For the questions, I'll probably go to, yeah. So the first question that we have here is, for the sake of simplicity, assuming that all contracts are entered on April 1, 2023, and the contract stipulates 1 month rent-free period during the first year during which the lessee uses the lease space to construct his leasehold premises, will be those improvements, with a discount rate of 10%, and an ROU and lease liability. What should be the ROU and lease liability? When it should be recognized, and at what rate should it be recognized? So this is the first question on hand. I can probably give you 2 minutes to just think through, work it out, and then I will share the answers with you. See, there are two critical aspects that you might have to keep in mind. One is the practical expedient, which they have discussed. And the second is, at which date do you think the lease liability should be recognized? So I'm just going to give you 2 minutes, and then I will take you through the answers. Got the answer. So we're assuming that all contracts are entered on April 1, 2023. And even though the contract stipulates that there is a 1 month rent-free period during the first year, it's very important to know that the commencement date, as per India's 116, is the date on which the lessor makes the underlying asset available to the lessee. I mean, I'm reading it from the standard, but yes, the commencement date is the date on which the lessor makes an underlying asset available for use to the lessee. So here we note that on 1st April 2023, the land was made available to the lessee, and the lessee had taken 1 month to construct their leasehold improvements. So often you find many such cases where the lease contract is entered, but the actual usage commences on a different date. But it's very clear that India's 116 specifically says the commencement date shall be the date on which the land becomes available for use to the lessee. So here the date should be April 1st, 2023. So the RU asset and lease liability should be recognized as of 1st April 2023. There are 2-3 very critical important items that that get discussed here. Just a second. So here they are saying, so here they're saying the contract has a fixed monthly price which is payable at the end of the year for lease and non-lease component. The lease component is 27,000. The maintenance, which is the non-lease component, is 3,000, which is primarily for security, maintenance, and other non-lease aspects. So let's quickly jump to what India's 116 says. So if you look at India's 116, para like 14 or 15, let's quickly go there. Why? Here they're saying the relative standalone price of lease and non-lease component shall be determined on the basis of the price the lessor or a similar supplier would charge for that component or similar component separately. If an observable standalone price is not readily available, the lessee shall estimate the standalone price. However, they have given a practical expedient. So the practical expedient is lessee may elect by class of an underlying asset not to separate the lease component from the non-lease components, and instead account for each lease component and associated non-lease component as a single lease component. So here they're saying if maintenance is a non-lease component and the rent is a lease component, the lessee can elect not to separate it, but instead account it as one single lease. So, however, there's an exception given for a financial instrument which is not applicable in our case. So, using this practical expedient, we can consider that the total lease payment is 30,000. So, I'll quickly take you to the solution. If you see here, the total lease payment is 30,000. The present value factor is 10%. So the lease for the first year, considering that there's 1 month waiver, will be 3.3 lakh. Second year will be 3.6 lakh. And the third year will also be 3.6 lakh. And the present value factor, because it's being done at the end of the year, would be 90.9. I mean 0. Convert this maybe. So it's 0.909, 0.826, and 0.751, which is nothing but 1 divided by 1.1. 1 divided by 1.1, the whole square. Again, 0.751. So this is how the present value factor has been determined. So you will find the discounted cash flow, the present value, which will be 2.29, 2.97, and 2.7. The total amount is 8.67 lakhs. I mean, it's 8,676.90 lakhs. So that will be the right of use asset and lease liability that you will be recognizing So if you look at the solutions, it'll be 8,676.90 lakhs. And the reasons are given below. The working with the reason is given below. Increase the size so you can see it. Should be done on April 1st, 2023 at 8,676.90 lakhs. Right? So we'll quickly jump to the second question. Second question is a very small iteration of this. So what they are trying to say here is to simply say, let's assume that the contracts are entered on 1st April. The contract again stipulates a 1-month waiver, and the company does not opt to use the practical expedient in discount. The same discounted rate of 10% is used. Then what should be the RU asset and lease liability? So in such a case, essentially what is happening is they are saying the lease component should be, so here in this question, clearly says that the standalone price. So we just read that, if where standalone prices are readily observable of the lease and non-lease components, then such rate shall be considered. So we are considering a lead of 28,500, lease payment of 28,500. So just replacing this 30,000 with 28,500. So we're saying the lease payment, the cash out per month is 28,500. And then you have this for 11 months, this is for 12 months, this is for 12 months. So together the same discount factors that we saw used above. Then we find the present value. It comes to 8,243.06 lakhs. Right? So you find that 8,243.05 lakhs. Again, the date will be 1st April 2023. So it's option C. Here you will have that workings. Right? Then we'll move to the next question. So this is on the supply chain models, right? So they're asking you which one of these is true. Push model supply chain is suitable for the retail outlet division. Pull model supply chain is suitable for the agency division. And then the risk of the pull model supply chain is overstocking and locking of inventory, locking of working capital in inventory. And high inventory turnover ratio implies that working capital gets locked in inventory for a longer period of time. So which of these following do you think is true? 1, 2, 3, and 4. I'll just give you a minute to think through. Right? Okay. So here I think we need to understand what is the difference between a push model and a pull model. So generally under a push model, stocks are produced on the basis of anticipated demand. So you have an anticipated demand, and demand forecasting can be done via various different techniques, such as operations, research, or data mining. So basically, in say an FMCG market, you will have inventory being stocked on a push model basis. Whereas under the pull model, you have stocks which are produced in response to actual demand. So this is a new business which is less product centric, more directly focused on the individual customer needs. So where there are a lot of customizations and things like that, you will have a more marketing oriented approach where stocks are only produced in response to an actual demand. So if you look at their retail divisions and the agency division, the retail division will be more under the push model, whereas the agency would be on a pull model. So the statement that the risk of pull model is overstocking and locking of inventory is incorrect, because in the pull model, stocks are only produced in response to actual demand. So this actually doesn't get triggered at all. So this is an incorrect statement. So the first statement is correct. The second statement is correct. The third statement, where it says that the risk of pull model is overstocking and locking of working capital, is wrong, because actually it happens. You could potentially say that it happens in a push model, but it definitely does not happen in case of a pull model. And the high inventory turnover ratio means that the working capital does not get locked, because the number of times that the inventory gets turned over is very high, because it gets converted into sales very quickly. Essentially, what we are saying is the number of times the inventory gets turned over is much higher, which means the working capital does not get locked. So that statement is also false. Therefore, the only correct statements are statement 1 and 2. So this will be your third MCQ. We'll move to the next question. Okay. So the franchise model decision. Why does Max Plus decide not to utilize the franchise model for its retail outlets? Is it to avoid legal complications? Is it to maintain direct control over operations? Is it due to lack of knowledge from potential franchisors, or do you think it's because of the high cost of franchise? So there were a couple of aspects that I pointed out when we were reading this study, reading this case. So they're saying the very reason that they wanted something like this, because they wanted to be done with adulterated medicines. And they also have somewhere, I think they would have also said, just to figure out where they said it. They would have said that they want to provide genuine, just a second. So they want to provide genuine and unaltered medicine. Since incorporation, even under the agency division, somewhere they would have said it's very important that their quality is important. They have direct control over the operations. So the answer to this is Max Plus does not use it primarily to maintain direct control over the operations. They ensure high quality of standards and services are consistently met across all the locations. That is the answer for the fourth question. Right? Right. And then the next question that we're talking about is ITC allocation under GST. So the information that they're given is during FY 2023-24, if the cost of all common inputs other than the lease rent is say 200 crores, the total sale is 300 crores, and of the total sales, they're saying 60% will attract 18% GNC and the balance is exempt. So they're saying very important. There's a very critical difference between exempt supplies and enumerated supplies. As far as this particular application of this rule and this section is concerned, we will talk about the section subsequently. But very important when you're solving it to note whether it's an exempt sale or an enumerated supply. Here they very clearly said that it's an exempt supply. So of 300 crores, 60%, which is 180 crores, will attract 18% GNC. The balance is all exempt supplies. So the amount of eligible ITC attributable for affecting taxable supplies will be, so they're asking you what will be the eligible ITC. Again, very important to know that they have given this 200 crores as common inputs other than the lease rent. The lease rent will also essentially be a common input. So very important that you keep that in mind when you're working this out. You will probably need 2 minutes to work this out. I will give you the time. Let me just quickly use this. Yes. And one other important assumption that you wanted to give you is assume that there's no rent waiver in the first month. Assume that this is a year in which rent is paid for rent is paid for all 12 months. And also assume that there is no ITC or integrated tax under 3.7, which is on imports. So there have been mentions that there's an item which is imported, right, of medical equipment which has been imported. Assume that there is no ITC on integrated tax under that section for this particular case. So these are two items that I want to flag. Okay, we will probably go to the answer. So let me just quickly open up GST section 17 and rule 42. So section 17 talks about apportioned credits and block credits. So section 17(2), subsection 2 to section 17 says where the goods or services or both are being used by the registered person, partly for effecting taxable supplies, including zero-rated supplies under this Act or under the Integrated Goods and Services Act, and partly for effecting exempt supplies under these acts. So what it's saying is, if you're partly using it for taxable supplies, if you're using goods or services, so basically goods and services are being used commonly for providing, for effecting both taxable supplies and exempt supplies, the amount of credit should be restricted to so much that the input tax as attributed with said taxable supplies, including zero-rated supplies. So they're saying the input tax credit should be only to those which relate to the taxable supplies, not to those which relate to the exempt supplies. Essentially, is what this section is saying, right? So now let's also look at Rule 42, which provides the mechanism under which you will be. So it provides the manner of determination of input tax credit in respect to input and input services and the reversal thereof. So here very clearly gives you the formula that you have to use, because here it just says that you only can take eligible ITC to the extent that you affected taxable supplies. But he's not giving you a methodology as to how you should determine which of these. So there could be there could be common ITC, like audit fees, for example, okay, that we charge, or they could be rent. So in one shop, I could be selling both exempt and taxable supplies, and it's quite possible, it's very possible that that I don't have a separate space for exempt supplies and separate place for non-exempt supplies, that isn't taxable supplies. So there is so those items will be called common inputs, right? So in case of these common inputs, how will I determine that what portion has been used for affecting taxable supplies and what portion has been affected for exempt supplies? So in such case, there is Rule 42, which gives you the clarity. So what it says is, the input tax left after attribution shall be called as common credit. So essentially, they're saying whatever common credit you take, call it C2, and then the amount of input tax credit attributable towards exempt supplies will be D1, which is equal to E by F into C2, where E is the aggregate value of exempt supplies during a tax period, and F will be the total turnover during that particular period. So essentially what he is saying is, you take the common credit, you multiply it by the proportion of exempt supplies to total supplies, and that will be the credit that you have to reverse. So basically he's saying eligible ITC will be only taxable turnover. I mean, if I have to put it in a different word, I mean, in the context of this particular problem, you will say taxable supplies divided by total supplies into common credit will be the eligible ITC. Exempt supplies by total supplies into common credit will be ineligible, which means you will have what you have to reverse under Rule 42. So I'll quickly take you to the answer. So here they're saying if common inputs are used, then only proportionate ITC of the taxable supplies is available as credit. So we're saying ITC on all common inputs other than rent. So he's saying the total turnover is, total expense is 200 crores. At 18% GST, it gives you 36 crores. ITC on rent, we're assuming that rent is being paid for all 12 months of the year. So it's 30,000 rupees per month into 12 months. And it's very, 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 very important. As the minutest of aspects are the ones which are very, very important. Because in this question, it clearly says that, as part of that vendor registration process, they very clearly said that out of the 100 landlords, only 50 landlords are registered in the GST Act and raise GST invoices. So smallest things can be very, very important in case study. So keep your eyes out whenever there are some numbers where some information is given. It's very important that you keep you keep marking them at least, so you can reflect back later when you probably flag anything that related to GST. You can probably put like a asterisk or something, so you can remember that these are the items that you have to keep in mind whenever you have a GST related question, right? So 30,000 into 12 months for 50 landlords at 18% is 32.4 lakhs. The total ITC, as a common ITC including the rent, will be 36.34. And directly we are applying the formula that is given in Rule 42, where it says, the total taxable, so it clearly says that 60% attract GST. So the taxable supply will be 60%. So essentially 36 into 60% will give you 21.79 crores. 21.79 crores will be the eligible GST that you can consider. With this, I think we come to an end of the MCQs. We'll now come to the descriptive questions. So the descriptive question is, compute the value of CT machine for the purpose of levying customs duty as well as customs duty and tax payable, right? So I'll quickly show you the details, and you can probably take 2 minutes to work it out. You can probably note this down, and then I will go down so you get the rates and the percentages and everything. Right? So let's quickly jump into the answer, right? So that's I quickly wanted to open the Customs Act and the customs rules and show you a couple of important aspects. So section 14 of valuation of goods gives you that for the purpose of valuation of goods, the rate of exchange shall mean the rate of exchange determined by the board, which is the CBIC rate. So it's very clear, as part of the Customs Act, somebody has raised their hand. Yes.
I'm sorry, ma'am. It has happened out of mistake. I'm
Oh,
sorry.
no worries. No worry. No worry.
I'm sorry to interrupt. I'm sorry.
Oh, not at all. No worries. No worries. So it very clearly says that the rate of exchange shall mean the exchange rate as determined by the board, which is CBIC. So we'll be considering the CBIC rate and not the RBI exchange rate. This is from section 14 of the Customs Act. We'll also quickly jump to the customs rules to say what are the relevant provisions that are applicable in this present scenario. So customs valuation determination of value of imported goods rules 2007, rule 10 says the purpose of this section, the value of the imported goods shall be the value of such goods, and they shall include, I don't know if it's visible, I'll quickly precise, the cost of transportation, loading, unloading, handling charges associated with the delivery of imported goods up to the place of importation, and the cost of insurance to the place of importation. So very clear is that, the cost of transport, loading, unloading, handling, everything has to be included in the value of the accessible goods, including the cost of insurance. So these are to be included. But then there are some provisos. The provisos in case, there are multiple provisos given in case if A is not ascertainable, what rate do you have? In case B is not ascertainable, what do you do? In case multiple different scenarios are given, in combinations of this is not available, that is not available. If together, if A plus the value of the good is available, then what you do? So multiple scenarios which are given. In our particular case, what is relevant to us is provided in case of goods imported by air, where the cost referred to in clause A is ascertainable. Clause A is the cost of transport, loading, unloading, handling charges. So that is ascertainable. Such cost shall not exceed 20% of the FOB value of the goods. So the FOB value of the goods will be the ex-factory price plus the freight until the airport and the loading and charges at the airport. That will be the FOB value of the goods, right? So after that, any cost that I incur should not be 20%, should not exceed 20% of the FOB value. It is is what the customs valuation rule says. So let's probably quickly go through the solution and show it to here only directly. So here you have the factory price of 8,500. you have the freight of 250 and loading and unloading charge of 250 together. So 8,000, 8,500 plus 250 plus 250 brings it to 9,000. So the FOB value of this particular item of import is $9,000. This $9,000, what they're specifically saying is a freight from load airport to the airport of importation should not be more than 20%. So the 20% of that value is only $1,800. So we should be capping it to $1,800, right? And then what they're also saying is the cost of the total cost of just a second. I mean, insurance will be at actuals. Insurance will be $2,000 because they've only given you a scenario where insurance is not given as per the valuation tool. So we don't have to apply anything specific. So for the purpose of the CIF value for the purpose of customs is 12,300. The exchange rate will be as per CBSE, which we already saw, which is 80. And now the question is, which basic customs duty rate do I use? So I think there again, there's some guidance which is given. Let me quickly see where I've given it. Customs Act, I think I have. Section 15 of the Customs Act. So, Section 15 of the Customs Act deals with the date of determination of rate of duty and tariff valuation of imported goods. So, here it says, in case of goods which are used for home consumption, it's very clearly given that it's for home consumption, on the date on which the bill of entry is presented. What they're saying, the rate of duty shall be, in case where goods are entered for home consumption, it shall be date on which the bill of entry is presented, right? However, there's a proviso. It says that if bill of entry has been presented before the date of entry inwards. So here in our scenario, let me quickly take you back to the question and show you. The aircraft arrived on 22nd of August. However, the bill of entry was presented on 20th of August itself, right? So in this particular case, the bill of entry was presented before the aircraft arrived. So here they're specifically saying that bill of entry has been presented before the date of entry inwards of a vessel or an arrival of an aircraft or a vehicle by which the goods are imported. The bill of entry shall be deemed to have been presented on the date of such entry inwards or the arrival, as the case may be. So basically, the section is saying in a very beautiful way, but essentially what they're saying is the date of customs duty shall be the later of either the presentation of bill of entry or the arrival of the aircraft. So they're saying whichever is later is what you will consider. If the bill of entry has been, if the aircraft has arrived before, then you will consider the bill of entry date. If the bill of entry date has been presented before, then you will still consider the date of the aircraft. So basically, whichever is later. Let me quickly take you to the solution also. Section 15 says that the rate of duty shall be the rate in force on the date of presentation of bill of entry or the rate in force on the date of arrival, whichever is later. So in our case, we have to look at the date of as of 22nd August. 22nd August, we already know that the rate has reduced to 10%. So we'll be considering customs duty of 10%. And then again, IGST will be available because it's an import. So you will be charging IGST. And then that's how we arrive at the total duty and tax there, right? Probably give you a minute to take it in and then we will go to the next question. Okay, we can probably go to the next question. Okay, so next question, very interesting topic. Well, do I take a forward cover? Do I take a money market cover? Or do I take a currency option? So as you know, for their agency business, they had imported a CT machine, right? And they had to pay some US dollars. So they've given you some, let me show you that also. So they're telling you at the time of the import, they have entered into a forward contract, but they have not considered other hedging alternatives like options and money market hedging opportunities. But they're asking you which would be most ideal. So they've given you the spot rates. The bank is going to buy it at 80, sell the US dollar at 80.98. The interest rates at 10%. The interest rate in US is 4% per annum. They're also saying interest rate parity will hold because actual rates will come through the theoretical forward rates. There are no arbitrage opportunities available. And they're also giving you that the bank charges a margin of 0.5% on its buying and selling rates. So you can again probably take 3 minutes to solve this by yourself, and then we will quickly go into the solution. Done? We'll probably quickly head to solutions tab that I have. Okay. So in this particular case, there are 3 options that we have to evaluate. First one being a forward cover, the second being a money market option, the third being an option. Right? I think the option, okay, I didn't even show the option. But yes, in terms of the option, you have a strike price of 81.21, the premium of 1.5. Again, the bank margins will also apply here. So let's quickly jump to the solution. So we'll evaluate these 3 options. First one is, see, this is a 3-month forward. You will have to evaluate it very carefully. You should ensure that you're taking the interest rate only for a 3-month period, not for the entire year. Because the rates are giving you on a per annum basis, but you will have to look for it at a 3-month basis. You will adjust it for a 3-month period. So the company is required to pay USD. It has to pay in INR to buy USD in order to settle this payment, right? So for this relevant rate that will be applicable is a 3-month forward. If you quickly look at it, essentially, so as per the interest, so here very clearly said that interest rate parity will hold because the theoretical will is expected to align with the actual rates. And therefore, we are following the IRP theory. With the IRP formula, the formula for IRP is 1 plus the interest rate in the domestic country by 1 plus the interest rate in the foreign country multiplied by the spot rate. So that will essentially give you the forward ask. So in our case, the spot rate is 80.98, right? They actually saw that the spot rate was 80.98. And then for the, so basically for the IRP numerator, what we've essentially done is 10%. I don't know if this is visible. Let me just. So the numerator will be for the forward cover and taking 10%, which is the rate in the domestic country in India. I'm adjusting it for 3 by 12. I'm saying 1 plus 10% to 3 by 12. So the numerator is 1.025. The denominator will be in US, it is 4%, again adjusted for 3 months. So 1 plus 4% to 3 by 12, which is essentially 1.010. And I multiplied by the spot rate of 80.98, which we've already seen above. Quickly take you there and show it. So spot rate is 80.98. It's the rate at which I will be able to buy it from the bank. The bank will be able to sell it to me at 80.98. The bank will be willing to buy my USD at 80.23. So I will be considering this 80.98 because I need to buy it from them. So when so essentially the spot rate is 80.98 into 1.025 by 1.010, which gives me 82.183. The bank, it's also mentioned that the bank is charging a margin of 0.5% on its buying and selling rate. So 0.5% on this particular amount gives you 82.594. It's also very important that these are all at T1. So you have to be very sure that, well, are you considering this at T1 or are you considering this T0? You have to ensure. So I usually like to write it down saying this will be at T0, this will be at T1. So it is, when you compare, you know that you're comparing the right elements against each other. So this is on the forward. So let's look at the money market. Let's look at the option case. So in case of option, the exercise price is 81.21 with a premium of 1.5. So together, if I take, see, one very, very interesting aspect is the premium I'll have to pay upfront. So at the premium will be paid at T0, whereas exercise price will be paid at T1. So I have to bring this T0 to T1. That is why I have to, 1.5 will have to be adjusted for this 3-month period. So I have to say, what I'm saying is 1.5 plus 1.5 into 1 plus 10% to 3 by 12. For 3-month period, I will be, I will have to spend this much of interest. Together, it becomes 1.538. The total INR spend at T1. So this exercise price will be at T1. This premium along with the interest will be at T1. Together, I will be paying an INR. The payout will be 82.748. Right. So under the option, the very, very important thing that you have to notice, the premium will be paid upfront. Therefore, you have to find the rate, which at T1. So let's look at money market hedge. In case of money market hedge, essentially what I'm doing is I am buying $1 today, and I'm borrowing INR to buy $1 to buy equivalent of $1 at T1. So I get some interest and I will be able to repay this $1 at the end of T1. So if I need $1 at T1, then essentially in today's rate, I am taking the interest rate applicable in the US, which is 4% for 3-month period. So in today's rate, what I will do is $1 divided by 1 plus the interest for 3 months, which is 1 plus 4% into 3 by 12, which gives me 0.990. So at today, I will need 0.990. So to get this at T0, I need to borrow 80.98. So 80.98 into, I will have to pay the bank premium also of 0.5% and buy the 0.990 US dollars. So the spot rate of 80.98, which we saw, multiplied by which is increased by my bank interest margin for buying 0.99 US dollars will be 80.579. And if I'm borrowing it at today, I will be repaying along with the interest of 10% at 3 by 12, which is 3 months later at T1. I will be having a payout of 82.594, which is nothing but 80.579 multiplied by 1 plus 10% for 3 months. So essentially, I'll be paying out 82.594. Right? So this is under the money market hedge option. So forward option is so much, option is so much, money market is so much. You will pick the cheapest one. So here, because I put it in Excel, I'm getting a lot of decimal points. But if you work it out, if you round it up, I think the question requires that you do it up to 4 decimal points. You will get a very small difference. So you will get 82.5937 here. You will get 82.5935 here. So the forward option seems to be the most favorable one. Therefore, it's preferred. But ideally, except for money market and IRP, if IRP holds true, in the forward option, if you're calculating the forward rate using IRP and you're also doing the money market, ideally those two numbers will at some point coincide. Very unlikely that you will get different numbers. Except for in case of bank premium would be a little different because you're using it to buy $0.9901, whereas that case it's a little different number. But otherwise, these two numbers will essentially be the same. So since the cash flows outflows lower in the case of forward market hedge, it is preferred. So this option is preferred. Right? So we've finished that. Okay. So they're asking you now to calculate the customer lifetime value per subscriber, given that they've given you present value factors. So 1 through 4 years at 10% is 3.169. The present value factor 1 and 2 years at 10% is 1.735. And using the information that that you were given here, which will pull that up for you. So this is the metric that you have, right? So using this, and also maybe I can copy it here so it's easier for you. Keeping this in mind, you can probably quickly work out what you think will be the presence value factor. It'll probably take you 2 minutes. Okay, so I'll quickly take you to the answer. So the net cost that I'm paying to acquire the customer acquisition cost will be 5,000 rupees. So he's saying the net revenue. So basically, this is a template that you can probably put together. So what will be the revenue per year? What is the PV factor? What is the PV of revenue? What will be the probability of you getting those customers, and what will be the net revenue, right? So revenue multiplied by PV factor will give you the PV of revenue, the probability of usage, and the net revenue that you get, right? So if I look at the net cost that I pay to acquire a customer, it is 5,000 rupees. It's the cost of the discount, the free offers that I give them, free tests that I give them, some coupons that I give them. Net of their subscription, one-time subscription fees, 5,000 rupees. So this is a negative 5,000, right? At day one, this is negative 5,000. And then I will also have net revenue from health products for year 1 and 2. So if you see here, they're saying the spend on health product is for the years 1 and 2 is 2,000. For years 3 and 4 is 1,500. So for years 1 and 2, it's 2,000. For years 3 and 4, it's 1,500. Spell on wellness products is 4,000 and 3,000. So it's 4,000. Wellness products for 1 and 2. For 3 and 4, it's 3,000. For health supplements, it's 2,250 and 750. 2,250 and 750, right? And the present value factor, he's given that for years 1 and 2, it is 1.735, right? And then for year, so then he has given you the present value factor for all 4 years, which is 3.169. So if you reduce 3.169 by 1.735, you get 1.434. So 3.169 minus 1.735 will give you 1.434. So for years 1 and 2, you will apply 1.735. For years 3 and 4, you will apply 1.434. I mean, you will apply it across health products and wellness products and health supplements. Right? And then you find the present value of revenue, which is nothing but the revenue per year multiplied by the P factor, which is the present value of revenue. Once you find the present value of revenue, it's very interesting that they have said, only 50% of the subscribers are expected to visit the pharmacy in year 3 and 4. For the health product, he's saying only 50% of the subscribers are expected to visit the pharmacy in year 3 and 4. Implicitly, this says that 100% of the subscribers are expected to visit in year 1 and 2. So you take so the probability of usage can be taken as 100% for year 1. Right? So for year 3 and 4, they have said it's only 50%. So the question says only 50% of the subscribers are expected to visit the pharmacy in year 3 and 4, which is 50%. That is where you plug in these numbers. And they're saying across all the years, only 75% of the subscribers who visit the outlet, the pharmacy, are expected to buy wellness products. Right? So for years 1 and 2, it will be 75% of 100%. And for years 3 and 4, it will be 75% of 50%. You agree? Because they are saying 75% of the subscribers who visit the outlet are expected to buy wellness products. So 75% of who buy the health products are expected to buy wellness products. So it will essentially be 75% of the percentage of people who are expected to buy health products. Right. The next year again, Kavitsan says only 25% of subscribers who visit are expected to buy health supplements in years 1 and 2, and 10% in year 3 and 4. Only 25% of subscribers who visit are expected to buy health supplements in year 1 and 2, and 10% 3 and 4. So essentially, who visit means who visit the pharmacy. So again, he's saying this will be 25% off 100% in year 1 and 2. And then they are saying it is going to be 10% off 50% in year 3 and 4. So the net revenue that you get will be 7,394. So I'll quickly take you to the solution that they are given, the study material. So net revenue that you get will be 7,394 rupees. Right? Okay, then let's quickly jump into so one other question that I think will be very relevant whenever there is IBS is how do you present it in the balance sheet? So I have a very small way of presenting it. I'll quickly show you, and then we can probably take a break 15 minutes after that. Okay, so annual discounting. I mean, I just took. I just plugged in these numbers. So the rate of discounting is 10%. Because it's an annual discounting. So I also wanted to show you that it significantly matters which discounting rate you take, whether you take daily rate, whether you take if there are monthly payments, the present value is going to be significantly different. And it's yearly payments, again the present value factor is going to be significantly different. So it's the numbers are very different. If I take it that lease is being paid monthly, whereas lease is being if lease is paid annually, then it is significantly different, the ROU and the lease liability numbers. So let's just, for simplicity, take the annual discounting. The rate of discounting is 10%. The lease starts on 1st April 2023. It's a 3-year term. So we are assuming that there's no renewal clause. If there's a renewal clause, then again, you will have to test it as per Ind AS 116. But for this particular case, there's no renewal clause. So lease ends in 31st March 2026. So how I I mean, regardless whether it's for work or whether it's for, when I was actually sitting there and solving problems, this is how I used to do it. I used to say, on which date am I making the payment? Which year is it? What is the total cash outflow? What is the present value of that cash outflow? This you can get the discounting factor. It's nothing but this. It's nothing but the 0.909 that we arrived in the first case. It is nothing but 1 divided by 1.1. That is all. But I've just presented it a little differently. So you find the present value of cash outflows, and then after you find the total amount, which is you find the ROU asset, you immediately charge depreciation. You start apportioning depreciation. So you start doing accumulated depreciation also. Then you also arrive at implicitly the WDV of the asset. Essentially, the WDV of the asset should be the right of use asset minus the accumulated depreciation. So those are very, very, see, if you put it together in a table, you won't miss some key items. So I like to keep it so I ensure that total becomes 0. So this is how I like to present it. To keep the depreciation, the accumulated depreciation, and the WDV. Yeah, so here. When you're pressing it in the balance sheet, for example, you'll also know that the WDV at the end is so much, and so much. Right? So you can, in the PNL, the depreciation number will have to go to the PNL, the WDV will have to go to the balance sheet. So you will have a lot of sums where they will require you to prepare a summary of India's related adjustments in the balance sheet and PNL. So they're very critical that you keep in mind the depreciation, the WDV, and the accumulated depreciation, of course. And then in case of lease liability, what will essentially happen? The same thing happens, right? The cash outflows will be the same, the PE of cash outflows will be the same, and then you have interest cost. Right? The interest cost is nothing but 10% of the net liability. That is all. Looks very complicated, but that is all this is. This is just 10% of the net liability. Right? So you find the interest cost for all these 3 years, and then you find the net liability also. And then the closing balance will be your net liability minus your cash outflow, including your interest. That is how you find the closing balance. Closing balance of lease liability will always be your opening lease liability plus interest minus cash flows, not present value of cash outflow, but cash flow. Also, one comfort that you should get is at the end of the period, the lease liability should become 0. That essentially gives you a comfort that you've computed the interest cost and everything correctly. And also another check that you can always have, very, very simple, is the period of cash outflow plus the interest. The cash outflow plus, what is this? This plus this will be the total cash outflow for you. That is also something that you can keep in mind. The total cash outflow will be 105 crores. The depreciation plus interest cost should necessarily be 105 crores. So there also you will get a comfort that what you're doing is right. So these are some small checks and balances that you should have in mind when you're solving these problems. One critical aspect is depreciation plus interest cost will necessarily total 0, because otherwise this 105 lakhs would be accounted as expense, right? So you also have to understand fundamentally why IBS came through. So IBS came through. See, we work a lot with, just take hotels, for example. Some hotels could be on a leased model, some hotels could be on a owned model. So if you take the balance sheets, in some case the EBITDA looks fantastic, in some case the EBITDA looks pathetic, because in some cases what essentially would have happened is I would have paid money, purchased the land, purchased the building, done some adjustments, and then all the costs would be, say maybe I borrowed money, I would be paying interest, and on that particular asset I will be charging depreciation. So both these items will not affect my EBITDA. So my EBITDA, if I'm a non-Ind-AS hotel, will look, actually, if I'm a non-lease hotel, if I'm operating on an owned model, my EBITDA will be much better than versus, I take a hotel which is running, which is already an existing building, which is owned by somebody. The land and building are being owned by somebody. I'm just going and operating it. Okay. In those cases, what will essentially happen is I will be paying lease. Lease will be a very significant portion. The lease will be part of my operating expenses. So when I'm looking at my EBITDA for a hotel that is operating on a leased model, the EBITDA will be much lower than a non-lease hotel. So that's why, and also if you look at the balance sheet for a own hotel, it looks very superior because it has a lot of assets. Whereas for a non-owned hotel, or leased hotel, the balance sheet will look very lean. So just to bring parity in these cases, to ensure EBITDAs of hotels. So if I'm doing a comparison of hotels, I will say this company is doing a much better EBITDA, right? That will be my analysis. If I don't go into see how many hotels are they owning, how many are they renting, without going to those metrics at a direct top level, if I'm going to make this comparison, these are apples and oranges. I'm comparing apples and oranges, and I cannot draw any comparison if I'm comparing apples to oranges. That's why it's very important to have both on parity. That's essentially why India has even came through for these asset heavy models which are leased. So you have to keep in mind that otherwise this 105 crores would have been paid as rent, right? So that is why the total of depreciation interest call will necessarily always include the total amount of cash outflow. This cash outflow for consider an AS company which does not have Ind AS, this 105 crores would have gone as a rent expense, right? So that's what you have to keep in mind. Similarly, you do this lease liability also. You have the cash outflow, you have the interest cost, then the closing balance. You will also split. For simplicity's sake, I'll also split this into how much is the interest, how much is the principal, and which year, right? And you can also give this, P&L. You will have this is what you have as right of use asset, closing balance. This is what you have, WDV, and this will be the closing liability of closing liability. One other very important aspect that you will have to keep in mind when you're presenting the balance sheet would be the lease liability will also have to be split as current and non-current lease liability. So that is also something that you have to probably keep in mind when you're presenting it. So the key aspects, I'm reiterating it because very, very important, because this is something that's very easy to score. It's just a presentation of a balance sheet. So you might have to mention that in cash outflow, you will show an outflow of 105 crores. I find a lot of people being very intimidated by Ind AS 116. It's actually one of the most simplest, one of the most organic, it comes through very easily. There are so many checks and balances that you can have. You know that you're doing the right thing. So yeah, that is what I want to bring to your attention today. And also, if you do daily discounting, so if you have, say, a monthly payout, unlike this. So in this particular case, when it initially said monthly payment, I thought it was going to be a monthly payout. But it turned out that the question especially caveated it and said it's a yearly payout. But in case you want to do a monthly payout also, this is what you do. You take monthly cash flows, you take the period of cash flows, and then we try to keep a snapshot again, same thing. But you find that the rate here, the right of use and lease liability is much higher because the payments are being made on a monthly basis. So you're preemptively paying it than paying it at a later date. For which reason that are you in lease liability, even though everything is same, just that the cash outflows are being faced on a monthly basis and not at a yearly basis. The right of use asset and lease liability are significantly higher than in case of annual payout. Also, be very careful whether the question says the lease rent is being paid at the end of the year or at the beginning of the year. The beginning of the year, then the PV rate that you apply should be different, should be 1 and should not be 0.9. So keep that also in mind. There's also some very important thing that you have to watch out to when you do this. So I think that brings us to the end of this Max Plus case. We've gone through everything in detail. So we can probably break for 15 minutes. I think the time is 7:55, I guess. We can reconvene at 8:10. And then we can go through the next topic quickly. By 9, after 9, I think you can have this Q&A session. That'll be the broad agenda, right? The second is a very interesting case. It's more to do with strategy, business decisions, and all that. So we'll reconvene in 15 minutes. Is that okay, sir? Mr. Deepak?
Yes, ma'am. Yes, ma'am. Yes, ma'am.
Okay, sir. Thank you, sir. Yes,
Welcome, ma'am.
I'll be back in 15 minutes. Are we all back?
Yes, ma'am.
Yes. I will just lessen my screen so for the next case study. Yes. Okay. So the next case study is something which is very interesting. I think there's a lot of strategic management related aspects. There are some interdisciplinary case laws that also come into play. We'll also look at some bit of taxation, some bit of legal recourses available in case of certain areas. We'll also be looking at what are the different methodologies that are available if you actually go into a real if there has to be a share swap or a demerger, M&A kind of a scenario. So what happens in terms of brand loyalties? So this is a very interesting case.
Ma'am, I suppose this particular case study is not put up on the portal. I mean, Max Plus is a part of the case study digest and it has been put up separately. But this one is not to be seen in the section wherein the weekly case studies are uploaded.
Okay.
So, can you just,
I wanted to upload it now.
Yes. Can you just put this across so that it will be
Yeah,
helpful?
absolutely. I can do that. So this is the portal that I have, right? Do you want me to upload it here?
Simriti, we will upload the same on Monday.
Acha. Fine. Okay.
I already had a discussion with
Upload
Mr.
same.
Deepak.
Actually,
Okay, fine, sir. Fine. I was just finding it out. I didn't get it, so that's the reason I asked.
actually, we couldn't upload because the last moment changes. That's why we couldn't
Yes,
upload.
I understood. I could figure it out. Okay, fine. Thank you, sir.
Okay, no worries. Okay, so we'll just quickly get started. So this is a very interesting case study. So what I think we will do is we will go through this in detail. We will also answer some queries which are questions which are given. There are some MCQs which are given below. There are also some descriptive questions which are given. So I think we will read. We'll take some time to read it together. It shouldn't take a lot of time. I think you should be able to finish it in 30 to 45 minutes. So that is the plan. So be very careful when you're reading it. I understand that you don't have a copy of this. So we'll read it together then. Yes. So this is one case which, talks about if there is a common brand or a common company, and then there are different, so the next generation comes and wants to take in a different direction, or there the father has started a company and then the two sons want to take the company in different directions, or they want to handle different segments of this particular company. What happens in such a scenario? How do you deal with the legal challenges? How do you deal with various stakeholders who are involved, including your employees, including your investors, including a lot of they could be SEBI companies at MCA, multiple stakeholders involved, bankers could be involved. So what do you do in such a scenario? And how do we handle it in a very professional way to ensure that the brand loyalty also stays? So what happens? Who will use the brand? Which segment will use the brand? How do we ensure that that there are any common assets? In case of lands, there's a huge land. How do you avoid? Not how do you avoid, but how do you plan in such a way that you don't have to pay tax on an asset which is already there with the generation itself, with the group itself? How do you ensure that just because when you change into a legal entity, when you want to transfer it to a legal entity, how do you ensure that capital gains does not get attracted in such a scenario? Because essentially the owners will still continue to be the owners, just that the legal entity changes. So in case that will be a unnecessary payment of capital tax. So in all these cases, how do we strategically decide to restructure your entire leadership, how to do a share swap, how to do maybe you do a demerger, a slump sale. So that's what this case is going to explore. How do we ensure that you do it in a very seamless way, avoiding conflicts? Because usually in case there is a conflict, yes, you will have to look at all those scenarios. But then how do you separate all these assets in a very, how do I say, compliant and also very non-conflict related way? Is what this case is going to explore. So let's look at this group. So there is this G group. Okay, it's India's oldest, most respected business houses. It's a cusp of a historic transformation. This was founded in 1860s. So you can understand that there have been 3-4 generations easily. The group has grown into a diversified conglomerate. They have FMCG, they have real estate, they have industrial engineering, they have appliances, agriculture, chemicals. So they're into multiple different verticals. So this has always been owned and managed by the G family over generations. The group has long held up the symbols of value-driven business and family unity. So they've always stressed that we should have a value-driven business and there should be family unity. So these are the two aspects that they've always stressed about. It's always been with the G family. However, there are some evolving business dynamics, some generational aspirations. There are different strategic visions, which eventually led to the decision to restructure the group. Right? I hope you're able to see it. Maybe I can increase the size so you can see it a little better. So there were some evolving dynamics. So the new generation comes up. Maybe they want to take it in a different direction. Maybe they want to be more innovative. Or maybe one person wants to invest more in real estate. The other person wants to invest more in FMCG. So there could be fundamentally very varying thoughts of how the business is to be taken and in which direction. So that evolved to a stage where they decided to restructure the group. So in April 2024, they publicly announced that the family has entered into a settlement to reorganize its business interests and ownership across two main branches of the family. One which was led by industrialists A and B, the other by their cousins C and D. So they decided that A and B will be leading one segment, C and D will be leading another segment. So this was not just a corporate slip, but it was actually a more carefully curated family arrangement that preserved the legacy of the group, that preserved the brand name, while ensuring that there was independence for future business operations. So it was done in a very strategic way, very well thought out, very well handled way to ensure that, we don't come out and show a picture of conflict to your stakeholders. Instead, it was done in a very amicable way. The case has also garnered a lot of attention, not just for the scale of assets involved. So scale of assets involved is an estimated 1.75 lakh crore of land bank. So it's land of 1.75 lakh crore which is available. So the case gathered attention not just for this, but also for the dignified and consensual manner in which the separation is executed. So very dignified and consensual. It presents an example of how modern Indian business families can manage succession, governance, and brand stewardship in a professional and emotionally intelligent manner. Right? They can manage succession, governance, and brand stewardship, putting the brand first before personal interest in a very professional and emotionally intelligent manner. So you will have strategic, financial, legal, governance aspects, the settlements. It will offer you insights to the complexities of family-owned business structures and how they've transitioned in the current world. Okay, so just to give you a company background, the legacy of the family, the structure of the group, the ownership pattern, the G Group was India's most respected business conglomerate. It was founded in 1860 by P. It was expanded by his brother Q. And they were always rooted in nationalism, self-reliance. They began manufacturing locks, soaps. Eventually, they involved into this 1.75 lakh crore empire. They, like already mentioned before, consumer goods, real estate, engineering, agri-tech. So they were into multiple different segments. The ownership has always remained with the G family, which is now in its fourth generation. The family's business is largely divided into G Industry Group, which is GIG, and GNB Manufacturing Company, which is GNB. So there are two different segments. One is the industrial group GIG, the other is a manufacturing company GNB. So GIG is led by A and his family, and they oversee listed entities. So the GIG comprise a lot of listed entities which are more investor facing, which are more SEBI compliant, where they uphold governance at one of the highest levels. So they deal into consumer products, properties, agrovet. They do all these things. Whereas GNB, which was controlled by C, as they control the unlisted industrial and legacy businesses. So they are more unlisted. They are more promoter driven. They are more they control only listed company. They don't do any investor facing roles, right? So unique aspect was also the family's land bank was around 3,400 acres in Mumbai, which was valued at 1.75 lakh crore. It was largely held under GNB. So the promoters had stake in both GIG and GIB. However, they were taking it in different directions. One was heading GIG, the other was heading GNB, but of course, the stake was with the family. Right. So despite their strong familial ties and shared legacy, differences in business vision, governance style, and succession priorities. So there were different business visions. Somebody wanted to pump in more money. Somebody wanted to stay a little more conservative. Somebody's governance style was more investor facing. So they had the highest levels of corporate governance. The other was more, unlisted. Their succession priorities also, the new generation, when it came in, They had different aspirations. They had different areas where they wanted to take the business to. So this led the family to consider structured separation to avoid future friction and ensure smoother operation across both business structures. So it was not something that was stemmed by conflict. It didn't come one day suddenly that two people decided and say they're going to go direct ways. It came more through actual understanding. The families sat together, decided that maybe we have to do it in a more structured way to ensure that succession of this brand continues and we avoid any future conflicts or future friction. So the business model and the group structure. The G group operates through a dual structured business model split between the two families, the GIG and GIB, like we already spoke. GIG, controlled by A, manages the listed entities, and they have a consumer product division where they have an FMCG business. They are taking care, they have household care, hair care, personal care. They have a global presence. They're listed companies. G Properties Limited is one of India's top real estate developers who are known for their large-scale residential and commercial projects. So this was G Properties Limited, which are into residential and commercial real estate development projects. And then they also had an agrovet, which is more of animal feed, crop protection, dairy segment, so more into agriculture and animal husbandry related fields. So these were the three products that GIG, which was overseen by A and his family, were managing. These were agile businesses. They constantly kept improving, growing. They were high growth businesses because because being a listed company, they were able to generate more money, generate more wealth, invest more aggressively. They were investor facing. They had a clear leadership and corporate governance norm because of their publicly traded firm. So this was how GIG was. Whereas in contract, GNB was chaired by C. This is a privately held company, closely held company. They had a strong legacy in manufacturing engineering. It continued to walk down that path. It owned some 12 unlisted companies across industrial, aerospace, electricals, furniture, appliances. They also had a significant, so GNB was where the land assets were. So 3,400 assets were in GNB, including much of its prime locations. So while GIG was seen as an investor-centric, innovation-driven business, GNB was more legacy-oriented, engineering-first ethos. So this bifurcated structure has contributed to divergent business strategies. So that was also one key factor that led to the family deciding that, let's go for a settlement and let's figure out how we do it, keeping the brand, but in, taking it in different directions, giving that freedom to take it in different directions. So the strategic decision-making aspects that were involved in this particular case, the decision to separate the G group's business interest was not one that was driven by conflict, but more as a pragmatic vision to unlock growth, to reduce operational overlap, to align with the evolving generation priorities. So over the years, the dual structure split between the G and the GIB has created multiple complexities. So the complexities were in terms of strategy. Like I said, investment, how do we invest? Where do I invest? Do I be aggressive? Do I be conservative? Brand usage. If at all there's a split, what do we do about the brand usage? Who will use the brand? Do we continue to use the brand? And resource allocation, right? So these were, if their land has to be allocated, how will it be allocated? What will be the tax implications? So the GIG led to A's family, which was led by the A family, focused on high growth, publicly listed. GNB, like we said, had the land holdings. So synergy between these two arms had diminished, particularly in brand strategy, because they were heading their own businesses, right? So there's no reason for a brand synergy, because they were heading their own things. They were their own verticals. So brand strategy was different because they wanted to take it in different directions. Corporate governance was different. Investment focus was different. And the next generation. So A's son wanted to come into real estate and do some headway. He wanted to make some aggressive investments. C's son was preparing to lead GNB. He had his own aspirations. So there was a clear divergence also. From ANC, it's now shifted to the next generation, and then there was a clear divergence in their long-term mission of these future generations. So this split will help them to pursue independent strategies without internal friction. Family recognized a structured separation under expert guidance was healthier than an ad hoc evolution. Decision was a forward-looking approach to family governance, preserving the relationship while continuing to position both these business arms for growth, operational clarity, and intergenerational community. Right? This is also something very important that you have to understand, that the family decided it not because, they didn't want to wait it out until there was a dispute, until there was a conflict, and then resolve it. So you must have heard of a lot of cases, when Mr. Dhirubhai Ambani passed away. in 2002, there was a conflict in Reliance. They didn't know which brother will do what, who will keep the brand, what will they pursue. And then in 2005, eventually they came to this conclusion that, industries will be held by Mukesh, one segment will be given to another. So that's what they decided in case of Reliance. That came about because, the succession plan was not there in place. They didn't know, there was no clear will, there was no clear succession plan. It had to come through, after years of conflict. The brand image suffered because there was conflicts. The investors lost trust in the brand. So to avoid all this particular G group decided that it's better, it's easier if they sit down and decide it right now with expert guidance, with some legal experts, with some professionals, rather than ad hoc letting it evolve into a conflict and then figuring it out. So that was also this was a forward-looking approach, a very pragmatic approach to preserve the relationship while also continuing to ensure that the business doesn't suffer. So the meaning of stewardship is basically putting the business's interest first before personal interest. So I think that is what is very important here. The challenges and conflicts was because it's a century-old business, came with a lot of challenges, particularly around brand usage. What do I do about the land? What do I do about governance? Most sensitive issue was the G brand. So G brand is a very famous brand in India. And it was a legacy name which was deeply associated with trust, innovation. So that nobody wanted to give up the name. They wanted to retain it for their own segments. For example, if you take Samsung, there was a split in the Samsung. I mean, when the next generation took over, there was this conflict in Samsung that, somebody wanted to pursue construction, somebody wanted to pursue electrical appliances, somebody wanted to do the maybe kitchen, somebody wanted to do the consumer segment. So there were multiple different streams that Samsung was pursuing. But one thing that the family actually sat down and did was they sat down and said, you know what, let us use the Samsung name. Let's not let it go. We will continue to use the name in whatever venture that we're doing. So the business, the family was given the option to use the brand name in all of their pursuits. So I think there also it becomes a very important factor of who uses the brand, because see, the brand cannot be seen as being very conflicting, right? On one side you have a brand when you have some business which is very conservative. On the other side you have a business very aggressive in making investments, in innovations. Then people get confused, right? If one company decides to, on one side, let's take some company for example, decides to be very conservative and not make any investments, invest only in FDs, not be a very growth-oriented company. On the other side, the brand decides to, deeply innovate. The brand positioning will go for a toss, right? So there you have these sensitive issues that come into play as to who will keep the brand, how will we retain the brand, how do we separate this as different verticals. So the legacy is also retained. While both the factions wanted to use the brand across different segments, and they have been using it across different segments, there was increasing ambiguity about its ownership, its application rights, and future use strategy, especially across listed and unlisted entity, which had distinct goals. So another fiction was this land holdings, valuing and dividing these immovable assets, some which are inherited, some which are developed, some which are under trust, is again very different because they have legal, emotional complexities, right? Because until now, everything was under one G and B, where the family was controlling it. Now, if you have to segregate it, then you have all these legal, emotional, all these issues. Plus, structure was also very different because some were inherited, some were developed, some were held in trust. So, how do I segregate it? Was also a challenge. The potential for monetization of the land was also made it a core component in the settlement process. Somebody wanted to take the land and monetize it. Maybe they want to start a venture, they want to develop the land. Somebody else will just want to retain it as it is. So that also create it's a core component of the settlement process. The governance mechanism, like we already spoke about, the listed company had to adhere with SEBI norms. It had to align with external investor expectations. They had made this investment believing the brand. So now they also had to, look at the governance aspects of it. So how do I do it in such a way that, I don't violate any MCA? Because the other one was closely held, so they could they could be much better off in terms of handling this governance related aspects. But if at all there has to be some compromise in this, then I have to go and get the shareholders approval because this was a listed company. So there were such considerations also in case of GIG, though not in case of GNP. So aligning these also was increasingly difficult. So the governance and family constitution, historically, they've always followed an informal governance process rooted in trust, shared values, and unified vision. Decisions were always consensus driven. There were key roles distributed to the senior family members based on their capability, based on the alignment with the business needs. So they were always, family first. They had key roles distributed to senior family members based on the senior key members' capability and their alignment with the business needs. While this effectively worked for decades, there was increasing complexity in the business. And of course, the newer generation comes about, there's always bound to be friction. So that also made it very difficult. And the fourth generation made it very difficult for the business to continue operating as a family unit. There was also lack of a codified family constitution, a formal decision-making body. So in a company, there's always a board. The board will take a decision. You have a defined delegation of authority matrix. You have all that in place, right? Unlike in a family constitution where it's more informal, where it's there is no constitution structure in place. There's no formal space, formal structure to take decisions. There are a lot of bottlenecks, especially in case of land monetization, other very emotionally sensitive areas. Younger members having different visions, they also wanted to enter the leadership ranks. So all these made it very difficult for the family to reconcile informally. So to navigate this, the family appointed a panel of trusted advisors. They were legal experts, financial consultants, governance professionals. These advisors facilitated structured dialogue. They drafted the terms of separation, and they ensured that assets were fairly distributed, they fairly valued, and then how they were being allocated is also very professionally done. Though a family council existed in principle, it had limited formal authority. So the settlement shows that there's a need for structured governance framework to ensure that the business continues, that there is transparency, there's long-term harmony, particularly as both families move towards different strategic paths. While they have while all along they had a common shared legacy, now they're going to move towards different strategic paths. So what are the valuation and legal considerations in such a separation? The G's family settlement involved significant valuation and legal complexities, given they had listed and unlisted entities, they had land holding, shared brand ownership. Most sensitive was, of course, GNB, which was an unlisted company. How can you value it? They had this land bank. How do you value the land bank? What do you do? How do you one family wanted to develop it, the other did not want to develop it. So how would you take care of that? So ensure fairness, the family engaged these financial advisors, and they just did not only have to look at the current market value, they also had to look at the potential monetization of the undeveloped lands and the brand equity across the business. It's not just that, I will take the land, I'll take the guideline value, I'll take the market value of the land, and we'll say this is the value and this is how we split it. But we also have to look at the potential. So because these were in prime areas of Mumbai, the value of a developed land would be much more higher than an undeveloped land. So, one company wanted to develop it, one stream wanted to develop it. So you also have to look at potential monetization avenues of such aspects, and how do I ensure that brand equity is maintained across the businesses. Okay. So what they essentially decided was the restructuring required a shareholding swap. Each family would exit the businesses which are not aligned to their future strategies. For example, C did not want to do anything in GHE, so they will exit from that, and they will be given a shareholding swap for the business that they're more aligned with. So they had to transfer shares across entities. They had to adjust cross holdings, all while ensuring that they are compliant with the tax laws, with SEBI guidelines, with company law provisions. So they had to do it in such a way that they are compliant with all these regulations, while also minimizing any impact if there is a transfer, if there is share transfer. There are a lot of implications that, from the corporate governance standpoint, you have to take a lot of permissions from the shareholders, from the tax laws. If the shareholding is more than so much percentage, then you have to, maybe Section 79 applies, could be a very small thing. And then if there's a share transfer, if there's a sale of an asset to another company, then you will also have to look at capital gains considerations. You have to be compliant with company law provisions also, in case you're going for a demerger or something like that. You have to go get NCLT's approval. So there are so many intricacies which are involved in this particular case. So structuring the deal to minimize capital gains tax, to avoid regulatory penalties, to maintain the business competitivity was all very essential. So these legal advisors are played a very important role to ensure that this was a tax-efficient, litigation-free settlement. So the family chose a family arrangement under the tax law, which is outside the purview of income tax. That specifically applicable. That specifically applies to capital gain tax. So in this particular case, there was a Supreme Court judgments also, where it said any family arrangement, if it fits into the definition of family arrangement, then the transfer will not be considered as a transfer of asset under Section 47. Therefore, capital gains will not be applicable. It's essentially what this particular arrangements is. So in this particular case, they did it in such a way that this came through the family arrangement cycle and did not have any capital gains implications. So the M&A restructuring model, the G's family is almost, again, we're talking through the same thing. One of the key drivers was to align business control with operational involvement. The brand rights historically shared were restructured to allow independent brand usage with defined norms. So they were saying for this consumer segment, you can use the brand in this particular defined way. And this is how you will use it for this, maybe the real estate business, in a way that avoids overlap, that avoids the market getting confused. So legal advisors also ensure that the intellectual property, the employee transition policies, and intercompany transactions were all disentangled from this. They were separately carved out to make this model non-disruptive for family business separation. To ensure that all the stakeholders, are properly taken care of, right? So, communication and stakeholder management. The G family was not just a strategic, the G's family settlement was not only a strategic business realignment, it was also a significant communication exercise because they had a lot of stakeholders involved. They had employees, they had banks, they had investors. So they have a lot of internal and external stakeholders for which a transparent communication protocol is very, very important. Initially, there were concerns that employees were worried about continuity, about what will be the brand identity, what will be the value system across these two, what will happen if I move to another company, another management. So all these are concerns that the employees had, particularly at GNB, which had multiple legacy businesses. However, to address this, the senior leadership actually came down and took them to a town hall. So they had these town halls where employees could gather together. They had a very clear statement issued saying, no, there'll be no job losses, there'll be no change in the brand ethos, there'll be continued focus on innovation and sustainability. So this was something that both the senior leaders came through and told the employees. So this gives them comfort. Otherwise, you will have this media running crazy, this employee morale taking a hit, investors on the other side putting a lot of pressure. To avoid all this, it's easiest when senior leadership comes and communicates very clearly, very transparently. So on the investor front, again, analysts had long speculated about its potential split because of this complexity, because of cross-holdings, because of governance friction. When the official announcement came through, it was seen as a positive development because investors were waiting for it for a long time. But because it came out very proactively and in a very amicable manner, they saw it as a positive development. They appreciated that there was a clear clarity that was brought through about ownership structures, about brand usage, future accountability. So this was a positive sentiment. So I'm not able to okay. Discuss that later. So the media and the market perception was also largely favorable, with many hailing it as a mature and forward-thinking move, in contrast to a more contentious family split, like in the past, that other companies had seen in the past. So the market and media also perceived it very, very positively. So the professionalism and confidentiality with which the transition was done we made it a case study in effective stakeholder communication in large families. So this became a benchmark in how to effectively communicate to all stakeholders to ensure that all their interests are protected, to avoid any conflict, any discomfort in the market, in the minds of employees, or any disruptions in the market. How to do it very, very positively and proactively is what came through. The strategic lessons that this particular offers is a lot of strategic insights on how to manage legacy family businesses, how to shift for how to account for these generational shifts. What is the importance of recognizing evolving priorities? Young leaders may want agility. The older generation will emphasize on legacy. There should be a focused growth. There should be a focused technological adaptation. So these were some aspects, that strategic lessons that came through from this particular case study. Another is the need for a structured succession plan. It's very important that, they proactively addressed it immediately before they went into a conflict. They were ensured that the next generation has clarity in ownership and autonomy in decision making. Instead of, having operational discomforts, they decided, they will have autonomy in decision making. And they did not allow tensions to escalate. They had a very forward-looking, very emotional, strategic, and financial considerations. Taking all those into mind, they had done it in a very forward-looking manner. What is also equally important is the governance framework. because so far the family has always operated on trust. Whereas scale of operations increases, it's important to formalize these structures. There was no family council per se, like you have in companies. So it's very important to have those governance structures. How to formalize those structures through family councils, professional boards, and legal advisors also becomes a very important learning from this. So also ensure that this is non-destructive for the business. Another thing is this reinforces that the family business must evolve with time, with transparent communication, early conflict resolution, clear demarcation of responsibilities. So this is what this case is all about. I think we've discussed quite a bit about the case. We will now discuss about some questions, right? So okay, so the G's family initiated the group restructuring due to different generational visions and strategic priorities. While one camp favored a diversified futuristic portfolio including so and so, the other focused on consumer products, simplicity. There were overlapping board memberships. There were conflicting capital allocation philosophies. The brand usage overlaps were also there. So the group's decision making had become very, very fragmented. Right. So now, given this scenario, what role do you think succession planning play in ensuring continuity in a legacy-driven conglomerate like G Group? Okay. And the next question is, how does a strategic misalignment between family members affect corporate performance? So what you have here is the answer. I will read through together. So in case of succession planning role, succession planning in legacy-driven conglomerates ensures that the leadership continues. It preserves the institutional knowledge that you've developed so far, legacy and engineering first ethos that you have. It will mitigate governance risk and foster innovation. It will also maintain stakeholder trust. All these will ensure that long-term strategic sustainability of a brand or a company or the group. So there are a lot of frameworks that we apply in such a case. So RBV is a resource-based view. Resource-based view basically means how a leadership and institutional knowledge will act as key competitive resources view. So you have implicit knowledge about the brand. There will be stakeholder relationships. You will have operational expertise. All these are very valuable. They are rare. They are inimitable. They are organized resources. So you have to start considering all these when you're planning a succession plan. You have to take a very resource-based view. Right. Smooth transition will help you prevent knowledge loss, ensure that you have a competitive advantage. So in this particular case, they had this deep-rooted expertise in real estate, consumer goods. Those were retained through a structured membership. So my knowledge, AS knowledge in maybe consumer goods, help them retain that particular segment. So you have to take a very resource-based view, and you can't just say this, it will be split 50% halfway. You also have this corporate governance theory, ensuring alignment between family and business interests and long-term sustainability. So putting rules and structures in place is very important for the business to run responsibility, to know who's in charge. In family-run business, usually you will have to have business and personal interests separate, which is very, very difficult because you can't segregate those two. So you should ensure that emotions don't disturb good decision making. So that is also very, very important. You should not take emotionally driven decisions. You should take decisions that is good for the business. Unplanned successions, in case of the Reliance case, affected successions. They led to power struggles, right? When you have a dispute in the Reliance, like seen in the Reliance the earlier years, that always in the stakeholders, everybody gets worried. Formal succession plan will reduce uncertainty for investors. So they had a clear constitution and roles and responsibilities were all defined to ensure that conflicts were avoided. And then there's also this dynamic capabilities framework where you adapt leadership transition to changing market conditions. Companies' ability to adapt and evolve over changing times. Very important that some legacy firms must retain balance along with the change of modernization. So some G's expansion into digital ecosystem, sustainability, FMCG innovations were all seen as very modern. We also have to ensure the succession plan ensures that the next gen leaders bring very fresh perspectives while respecting the legacy that the brand has so far built. So considering that the brand ethos is retained, however, you have to bring some kind of technological innovations. The institutional theory, of course, that companies which have been around for a long time are always seen as reliable. They need to maintain their legacy, reputation, stakeholder expectation across generations. So investors and employees, customer associates, legacy firms are built with stability and trust. Transparent succession plan reinforces brand reputation is maintained, prevents market skepticism. This is the institutional theory about companies which have been around for a long time, companies which have always been seen as reliable. So what is the impact of strategic misalignment? So strategic misalignment essentially comes when there are different, because of a lot of issues that we saw, it will erode your competitive advantage. It will get the stakeholder to distrust you. There'll be a cultural fragmentation. So you can't do anything. You can't pursue anything because there will always be cross holdings, and you will have shared board memberships. So frameworks like we discussed above are very, very important. What other aspects are also important is agency theory, where conflicts between family owners and managers, family factions. For example, one family wants to invest in real estate, the other wants to stay conservative. So this misalignment can slow down things, confuse the company's direction. So one cannot even invest, the other wants to stay conservative. Very different. How do you resolve this conflict? It becomes a very big issue. And then stewardship theory is always that family will act as stewards of the business and prioritize. They will not prioritize personal interest. They will always prioritize the business. So stewardship basically means, do you act in the company's best interest or do you act for a personal gain? So that always is very, very tricky when it comes to a family-owned business. Right? We'll go to the next one. So next question is on brand rights and asset division. The biggest hurdles that they had was this G brand, which was a 125-year legacy. They had land mass, real estate valuations, and all these. So given different business models and geographic interest, how do they share a same brand? How do they revalue intercompany ownership was one major issue. So why is brand IP separation challenging in family business which have shared legacy, and what legal and financial considerations might be addressed while dividing common assets like land? These are the two questions that you would have to explore. Let me quickly have a sip of water, please. So brand separation challenges in family business like the G group was very difficult because they were so far had this legacy of that G brand. They had some emotional ties with it. They had legal complexities to it. So example is, we will discuss a couple of examples below to show how co-branding works, how sector-specific licensing can work. So G's plan was to co-own but operate independently, which reflects a compromise. So they all wanted the brand. They wanted to co-own the brand, but they wanted to operate independently, which is a compromise, but compromise in the right direction. So let's look at the Reliance case. So Ambani India, what happened was when Dhirubhai Ambani passed away in 2002, I think there was public fights, there was media coverage, there was damaged investor confidence. Business decisions were slowed down because they didn't know who should decide, and the shared brand Reliance also caused confusion between customers and partners. So it became a very big concern. It drew out for a long time. In 2005, I think they split between Mukesh for Reliance Industries, Petrochemicals, and Anil took over ADA Telecom and Power. So brand separation also was done in such a way that Reliance retained it for the core energy and retail, while Anil was able to use it for communications. This is what happened in Ambani's case. The Murugappa Group settlements in 2020s was, Murugappa Group was a very patriarchal led family, where what happened was one daughter wanted a board membership considering she had some 8.5% of shares, and that was again disputed by the family. So they had disputes over what do we do, how do you give ownerships and things like that. They entered into a very legal settlement which was not publicized. They entered into a family settlement. They had now what they also continue to do is they have structured shareholding arrangements. They have sector specific branding. So they have TI Cycles, they have Cholamandalam Finance, which operates semi-independently. And then I think around 2003 or 2023 or 2024, they entered into a hush-hush agreement. So that was also one settlement that comes into play as to how brand plays a very important value. And then Samsung, which is a South Korea family, the heirs of the Lee Kun-hee divided stakes in Samsung affiliates. Somebody took electronics, somebody took construction, but they retained the brand. So they decided that no matter what, they will always continue to use the Samsung brand. It will remain unified until under a holding company. It will prevent dilution despite ownership splits. And even today, they have, I think, Samsung Construction, Samsung Kitchen, Samsung Electronics, Samsung appliances. So they have multiple different but they using the common brand for it. So they've retained the brand in this way. In L'Oreal, what happened was Lillian Bettencourt's hairs fought over the control for the cosmetic empire. Her daughter came in and she said she wanted to use it. She felt that the ownership was being given to somebody else, some friend. There was a case which went through, and again, it came to a legal settlement where the brand was kept intact with under a trust without selling it off. So one good thing that happened here was Nestle was a neutral stakeholder. Nestle was a stakeholder even before this conflict came through. They continued to be the one who are negotiating this. They acted as a neutral stakeholder. They amicably acted as a mediator. So that's where having a mediator is very important in case of these legal settlements. A neutral mediator becomes very important because families have a lot of emotional ties, so emotionally there are a lot of conflicts also. So as far as the asset division considerations are concerned, you will have legal considerations as to who will own it, who will have title. There are many groups which are held under family trust, joint holding companies, subsidiaries. Some were inherited, some were developed. So what do I do? So in that case, you will need a clear partition deed or a demerger scheme. You also had a lot of trust and succession laws because some trusts had these irrevocable clauses saying you cannot divide it. So what do you do in those cases? How can you resolve it without litigation? So you can amend the trustees. You can create new trustees for divided assets. So you can always do that. So there are always ways to mitigate this also. So you also have corporate law compliance, like in terms of Companies Act, SEBI, FEMA. So the land is held by listed companies, heavy regulations will apply. So transferring the land between the families will require a shareholder approval. So in that case, what do? You go in for a scheme of arrangement. You go for like a court-approved demerger in case of Reliance Industries split. So that is what you do. You also try to keep it as tax neutral as possible. You also ensure that independent valuations are taken to ensure that assets are allocated in a very fair manner. Right. And then you will also have to look at regulatory approvals like RERA, state land laws to ensure that, these are compliant with all these rules. The financial consideration is how do you value these assets? So some assets could have appreciated significantly. The cost could be a very small portion, but the actual value could be significantly higher. So how do you value it? You take independent valuations by reputed firms, or you enter into some kind of swap mechanisms where somebody gets shares in return. So you can also have these kind of valuation considerations, and this is how you mitigate it. And they will also have tax implication because when you transfer, then you have 20% long-term capital gains, unless you do it as a slum sale or demerger. Some stamp duty could be 5 to 7%, as high as 12% in some states. So you will also have to pay a stamp duty in such a case. Then you try to use tax neutral demerger rules, or you try to stagger transfers to optimize tax liability. So these are opportunities that are available in case of mitigating tax implications. How do you allocate debt and liabilities? So the land is mortgaged and there's a loan taken against us. Who will assume the liability? So you can always go into debt structuring agreement. So in the SR group split, that is what they decided. They decided to restructure the debts. And you can also try to get the bank and the non-convertible debenture holders consent for these asset transfers. So that might also be implicit. You should ensure that these are taken into consideration before you allocate these debts and liabilities. Liquidity and long-term holdings also a concern because some people might want to monetize the land, some people will want to hold it for a longer period of time. That's why you can maybe have a real estate investment trust, REIT, which can be traded. So you can unlock it without even selling it. You can have REITs. And then you can even have maybe joint ventures. You can lease land to developers. That is also possible. Okay. And then the next question is communication and stakeholder alignment. So post this, employee groups, investors, partners, everybody will raise concern about the continuity, what is going to be the cultural integrity, what's going to be the financial impact. So although the deal was internally aligned, the G group needed communication strategy to maintain trust and manage perception. So what was the risk? What is the risk of poor communication during a high-profile restructuring? How can stakeholder confidence be retained during such transitions? So the risk of poor communication is in case of a family split, there will always be a reputation loss. There will be an irreparable damage to the brand. There will be an investor panic because people won't know what's going to happen. There will be legal disputes. So a strategic communication plan is very, very important that you have a very pragmatic, very transparent communication plan to avoid all this crisis when you change frameworks. So reputation damage in case of 2005, the Reliance brand took a hit. So media led to speculations, customers and investors had skepticism. So one aspect of a bad community system is the damage to a reputation. And then employee morale and talent attrition is very, again, a very critical aspect, because the uncertainty about who will lead, which direction will the brand go into. The Tata missile mystery followed was a very typical case of, uncertainty about leadership will essentially flow down to the employee morale and the potential attrition of your employees. So it's very important that you have internal messaging very clearly. In case what Godrej did was, the senior leaders took them to a town hall and told them this is how it's going to happen. We will always continue to have focus on technology. The morale is never going to change. The culture of the company is never going to change. The brand is going to continue to be retained, is what they said. Investor and market reaction, stock suddenly, if somebody announces there's a conflict, the stock price will immediately become volatile. The Bajaj Auto 10% fall during the family split. There'll be credit rating downgrades if lenders perceive that there's instability in this particular group. So that could again be mitigated by doing a very proactive communication. Regulatory risks like miscommunication with SEBI, MC, Ministry of Corporate Affairs, tax authority, which would attract scrutiny. So minority shareholders may sue for lack of transparency, which is what happened with Infosys in 2017. So these are the regulatory and legal risks of not having a very transparent communication system. And the family relationship breakdowns could also happen. So there could be emotional conflicts, which could escalate into legal battles, like the Birla family had a lot of legal issues. Future collaboration becomes impossible, which will hurt, in this particular case, there was no synergy. But if there is a potential for a long-term synergy, that also gets affected if you have a family relationship breakdown. So it's very important in such a case that you identify the stakeholder theory approach is you identify who are your key stakeholders. So internally, who are your stakeholders? Externally, so internally you will have family members, employee or board members. Externally, you will have investors, regulators, media, customers. You tailor the messages very, very clearly. So employees, so what will employees be worried about? Employees will need confidence about job security. They want to know that the brand is being retained. Investors will require financial clarity. The media needs to get very controlled and consistent narratives. Two people can't come and say, one leader A can't come and say something and C come and say something completely opposite. So it has to be a very controlled and very consistent narrative between the two parties who are having this breakdown. Crisis communication model, which is Coombs situational crisis communication theory, SCCT model. The basics, there are a lot of items that he's spoken about, but some are the preemptive strategy. So he says announce restructuring before the leak occurs. So you control the narrative instead of letting the narrative control you. You announce it. Take corrective action. Clarify if there's any misinformation. You immediately go and clarify. Don't let it steep and then go 10 days later, because the damage would have been done by that point. And reputation repair. So use some narratives saying the 125-year-old values will always remain intact. So use some narratives like this to put that thought across, that message across. So corporate governance frameworks, which always speak about transparency, to disclose settlement terms to regulators, shareholders, have an independent oversight using a neutral mediator in case of the Tata mystery case. Documented, publish family constitution post-settlement like the Murugappa group did, do something like that. And then change management. The Porter has an 8-step model, which we're just going to discuss, the top 3 things which are relevant, maybe. Create an urgency, explain why it's necessary. So try to go and say why this is necessary, and this is why I had to do what I had to do. Form a coalition, align senior members before you go and make public announcements. Sustain the communication. So regularly update them via calls, memos, press releases. So constantly keep doing it. So if you follow this, it will ensure that, communication, stakeholder interests are protected. Have an integrated brand management strategy. Preserve the brand. Ensure that, this group remains united in value. Say something like that. Differentiate new entities. If you're using sub-brands, you use different brands. You can use Titan also. You can use, Tata Group uses Titan, Tata Group uses Tanishq. It uses multiple different entities also. So you start using sub-brands. And so this is a very this simple chart of what we already discussed. So investors, how to retain the confidence, employees, customers, and regulators, what you have to do. So we will quickly jump to the MCQs, and after this we can probably finish the session. So what do you think is the primary objective, primary strategy driver behind G's family to restructure their business holdings? What is the primary strategic driver behind the G family's decision to restructure their business holdings? Is it to resolve a public legal dispute between the family branches? Is it to unlock growth by reducing operational overlap and aligning with generational priorities? Is it to merge all business under a single listed entity for better valuation? Or is it to exit legacy business and focus only on FMCG and real estate? What do you think is the reason, primary objective, strategic driver behind G's family's to restructure? Very clear that it is to unlock growth by reducing operational overlap and aligning with the generational priorities. It's very, very clear, just came through in multiple things that you've read in this case study. So they wanted to ensure that future generation are being given an opportunity to pursue, take the business to new directions and newer heights. So that is the reason why they had to split. The split was driven by divergent business visions, different governance styles, next generation's aspirations. It was not driven by conflict. So why did the G family engage external advisors during the settlement process? Is it to mediate personal disputes between the family members? Is it to ensure compliance with SEBI, tax laws, and fair asset valuation? Is it to help sell off underperforming businesses? Is it to manage day-to-day operations during the transition? Right? It's clearly to ensure compliance with SEBI, to ensure that assets are being allocated in a very fair manner, to do away with all the complex legal, financial, regulatory considerations. Therefore, that's why they appointed legal advisors. There was no conflict at all in the first place. They did not help. They did not want to sell off underperforming businesses. They wanted to take it in different directions. They did not want anyone to manage day-to-day operations. They were able to do it themselves. So the main reason is to ensure compliance with all these and also ensure that there's a fair asset allocation and valuation. So, what key governance challenges the G family faced before the settlement? Was it a lack of formal family constitution leading to these bottlenecks? Was it the resistance from shareholders in listed companies? Was it government intervention and land monetization, or is it overlapping management roles in all these subsidiaries? We discussed this in detail. It's always a lack of formal family constitution leading to strategic bottlenecks. So they did not have, like we discussed, like a company has a board. They did not have a family constitution in place as to who will decide. So that informal structure became very unsustainable as the complexities arose and the generational differences grew. And how was the G brand ownership addressed in the settlement? Did one branch retain exclusive rights while the other had to rebrand? Did both branches continue to share the usage but with defined norms to avoid overlap? Was the brand sold to a third-party investor, or was the government mandated a joint custody arrangement? Again, very, very clear that both branches continue to share the usage but with defined norms to prevent market confusion while preserving the legacy. The last one is, what is the most sensitive asset that you think which required very careful valuation during the exercise? Was it the overseas subsidiaries? Was it the patents? Was it the land bank? Or was it the philanthropic trust? Like we discussed, it was a 3,400 land bank, which had very high monetization potential. It had a lot of emotional significance, and the valuation also was very, very critical in this particular case. Somebody wanted to develop it, somebody wanted to retain it. So that's why it became very, very important. I think with this, we come to the end of the session. Yes. Yes. If you have any questions for me, you can leave it and then I can probably reply to you in the portal. The question, either the first case study went through or the second one that you went through. So, yes, Mr. Deepak, over to you.
Thank you, ma'am, for sharing such valuable insights on approaching IBS case studies with the right mindset and strategic thinking. Students, please go ahead and raise your queries.
So should I stay for this?
You can leave, ma'am. No problem.
Okay, perfect. Okay, okay. Thank you, sir.
Okay, welcome.
Thank you so much, ma'am.
Students, there is a query in my chat box. I am appearing for group 2. How can I prepare for group 1 papers, especially for the IBS exam? Students, that's a great question and a common issue among students preparing for CA final. Okay. Here is a smart strategy. Even if you are focusing on group 2, it's a good idea to pick one or two paper from group 1. Okay. And prepare them thoroughly, especially those that can significantly help you in IBS. Now, I suggest you FR. This is highly recommended. A strong grip on FR will not only help you score well in IBS, but also prove immensely useful in your professional life after becoming CA. It builds the foundation and application of accounting standards in Ind AS. Okay. Second area is advanced financial management, ideal for those who are comfortable with practical problem solving. It sharps your decision making skills in area like capital budgeting, valuation, etc. Third one is audit and assurance, a good choice for students who have good practical exposure through articleship or work experience. Now, SATE, corporate and economic laws. Corporate governance is very, very important. Most case studies involving body corporate and question can be directly connected or linked from corporate governance portion. Okay. If the company is listed, then SEBI LODR regulations are highly relevant. Or I am sure you will get questions from these areas also. Regarding strategic cost and performance management, this is core for decision making. Okay. Focus on understanding of strategic models like Porter's 5 Forces, McKinsey 7S, Altman's Z score, value chain analysis. These models may be tested in your examinations because these are core for decision making. Okay. And compliances part is connected with strategic decision making. Okay. Now, here is very important question. What about the remaining subjects? Should I ignore? No. You don't need to ignore. Okay. You don't need to study every subject in very, very detail. But you should have at least basic understanding of all areas. Why? What I told? Pick one or two subjects from group 1 and get good understanding on those subjects. What about others? You should have at least basic conceptual understanding. Why? Because during the exam, you may be able to identify the relevant concepts and apply it correctly. If you know the concept in a well manner, only then you can apply. Or if you have at least basic understanding of the concept, you can easily apply the same in examination conditions. Therefore, you should have at least basic understanding of remaining area. For best results, build your foundation before the exam. Don't rely solely on searching and referencing under the pressure. Okay. Now, conceptual understanding is designed to test your conceptual clarity and application skills, not just your ability to find definitions or formulas. It is about how well you understand the concepts from each subject. Apply them in the given business situations, like how a CEO, finance director, auditor would analyze complex integrated scenario using multidisciplinary thinking. Why rely on modules or search and copy won't work in this situation? You may spend too much time trying to find the exact section or theory in the module. During examination condition or under pressure condition, okay, search and copy won't work. You may spend too much time on searching. If you don't truly understand the why behind the concept, even if you find the right term or right concept, you may end up by applying wrong concepts, which will hurt your marks. You might answer one question by copying, just simply copying or paste, but you will likely to run out of time for the rest. What you should do in this situation? Focus on understanding the fundamentals of each subject, like how performance evaluation works, what strategic framework means. Use case studies, practice questions, and integrated scenarios to test yourself. The more you practice applying theory in a variety of contexts, the more confident you will become. The ICAI's module are excellent reference tools for revision, for clarity, for supporting your answers, but they are not mean to be your sole source of answer. This exam rewards thinking like a professional, not just a student. When you approach it with a mindset of analysis, strategy, applied understanding, you won't just pass, but you will stand out. Now, how to structure answer for full 12 marks? Okay, I have so many times I have given so many times this example. Suppose it in a requirement a requirement says to assess competitive okay, to assess competitive is applicable, and this model is Potter's 5 forces. And Potter's there are 5 forces. Okay, each of 5 forces is a major heading, and questions worth is of 12 marks. Then you have to divide 12 marks into 5 points. It means every point will have weight around 2.4 marks. Then you have to write at least 2 or 3 points in each force. Okay. To get good marks, divide 12 marks into 5 forces, which is equivalent to 2.4 marks. For getting 2.4 marks, you have to either write 2 or 3 points in each force along with conclusion. Only after that you will get full marks. Okay. Another point is very important. Read the requirement very carefully. If a question asks you to evaluate firm's supply chain, okay, then you have to give not only strengths but also weakness. Okay. Evaluation is successful only when you give both positives and negatives. Now, students, I will explain. There is another query. There is another query, and during examination special tips. Okay. Students, use the initial reading time wisely. Okay. Start by going through the requirements part. Okay. Identify the ones you are most comfortable with. This helps in better time management and boost your confidence. Don't ignore MCQ section. Since MCQs carry 40% weightage, keep an eye on them. While reading a case study, it is very important. While reading a case study, jot down key points based on the question requirements. For example, if a question is related with Ind AS 106, mark or note down important words, figures, or paragraphs that seems relevant. This early step is extremely useful for drafting your final answer. I always say it is a mind map, or sorry, it is sketch making. Whenever you start drafting solution of a case study while reading, make a sketch of solution. This sketch will be helpful for you while drafting final solution. You may need to refer to study material during the exam. Some students create their own index or to navigate quickly. That's fine. But best index is in your mind. If your concepts are clear, you can scroll and find what you need efficiently. If not, you may end up by wasting time in searching. Okay. One another important tip: start answering on left hand side page. This give you the right side for any rough work or calculations if required. Always attempt all required questions. Make sure you cover all parts of the paper. Okay. Even brief answer can fetch marks. Students, अब मैं ये हिंदी में आपको एक्सप्लेन करूंगा थोड़ा सा. यहाँ पे हिंदी के भी स्टूडेंट्स हैं, उनको मैं थोड़ा सा गाइड करूंगा अगले 5 और 7 मिनट्स. देखिए इस पेपर में क्या है कि आपको बेसिक कॉन्सेप्चुअल अंडरस्टैंडिंग का होना बहुत ज्यादा जरूरी है। ठीक है, अगर सपोज आप ग्रुप 2 के अंदर अपीयर कर रहे हैं तो आप क्या करें कि एक या दो सब्जेक्ट को ग्रुप 1 से लें और उसको थोरोली प्रिपेयर करें। इससे क्या होगा कि वो सब्जेक्ट आपको अभी तो काम आएगा ही आएगा, लेकिन बाद में आपका वो प्रोफेशनल लाइफ में भी आपको यूजफुल होगा। अगर आपने फाइनेंशियल रिपोर्टिंग लिया तो वो जो इंडियन अकाउंटिंग स्टैंडर्ड्स जो अभी आप स्टडी कर रहे हो, सब्जेक्ट्स तो आपका क्लियर करेंगे ही करेंगे, लेकिन बाद में जब आप प्रोफेशनल लाइफ में आओगे, चाहे आप प्रैक्टिस में जाएं या जॉब में जाएं, तो वो आपको तब भी यूज आएगा। तो इसलिए आप अपना माइंडसेट चेंज कीजिए। आप ये नहीं सोचिए कि हमें तो सिर्फ 2 पेपर देके और ग्रुप में अपीयर हो जाना है। आप सोचिए कि आप 2 पेपर नहीं देने, आप सोचिए 3 या 4 पेपर देने हैं ग्रुप में। लेकिन ये जो मैंने आपको बताया कि जो 1 पेपर या 2 पेपर सेलेक्ट करना है, इसका मतलब ये नहीं कि आपने दूसरे पेपर्स को इग्नोर कर दिया। ठीक है, उनकी बेसिक कॉन्सेप्चुअल अंडरस्टैंडिंग होनी बहुत जरूरी है। अच्छा, बेसिक कॉन्सेप्चुअल अंडरस्टैंडिंग होनी क्यों जरूरी है? अगर आपको बेसिक कॉन्सेप्चुअल अंडरस्टैंडिंग होगी, सपोज कोई एग्जाम में इजी क्वेश्चन आ जाता है, और अगर आपको बेसिक कॉन्सेप्चुअल अंडरस्टैंडिंग होगी तो आप इजीली अपना ओपन बुक को यूज, ओपन बुक एग्जामिनेशन है तो इसलिए आप अपने रिसोर्सेज को इजीली यूज कर सकते हैं। अब कैसे? देखो, इस एग्जाम का मतलब ये नहीं है कि आपको बुक्स में से आंसर को ढूंढ ढूंढ के ट्रेस करके वहां पे चिपकाना है। ठीक है, इसका मतलब है, आप समझिए, अगर आपने अगर आपको कॉन्सेप्चुअल अंडरस्टैंडिंग है तो एग्जाम में सपोज कोई क्वेश्चन आ जाता है तो आप क्या करोगे? आप इजीली आप मॉड्यूल के उस पेज पे पहुंच जाओगे जो आपने स्टडी किया है। ठीक है, अगर आपको पता ही नहीं मॉड्यूल के अंदर क्या है तो क्वेश्चन कुछ भी आ जाए, आप ढूंढ भी लोगे ना, तो एक या तो कॉन्सेप्ट को गलत अप्लाई करोगे, और अगर कॉन्सेप्ट अप्लाई भी कर दी तो आपका इतना टाइम किल हो जाएगा कि आप दूसरे क्वेश्चन का सॉल्यूशन करने के लायक ही नहीं रहोगे। आपका टाइम ही किल हो जाएगा, टाइम ही खत्म हो जाएगा। लेकिन अगर आपको कॉन्सेप्ट की बेसिक अंडरस्टैंडिंग है तो आप इजी वे में ओपन बुक रिसोर्सेज को यूज कर सकते हैं, और आपको आंसर भी आपका क्लियर हो जाएगा बिल्कुल। ठीक है, हाँ, कई बार ऐसा होता है कि जब हमने अगर हमारे को बेसिक अंडरस्टैंडिंग होती है तो कई बार हमें जैसे कोई कॉन्सेप्ट है, हमें लगता है कि वहां मॉड्यूल में तो 7 इयर्स लिखा था, वहां 8 इयर्स है, क्या है? तो इस मतलब अगर बेसिक अंडरस्टैंडिंग है तो आप इजीली मॉड्यूल के उस पेज पे पहुंच के और आप आराम से देख लोगे कि हाँ, वो वहां पे तो 7 इयर्स ही था। ठीक है, तो इसलिए बेसिक कॉन्सेप्ट्स की अंडरस्टैंडिंग होनी बहुत जरूरी है। ठीक है, अब एक कंफ्यूजन बहुत बड़ा ये आता है कि स्टूडेंट्स कहते हैं हमने तो स्पॉम जो है हमने तो ऊपर ऊपर से पढ़ लिया। देखिए, स्पॉम के अंदर क्या है कि स्पॉम के अंदर सेट ए बहुत इंपॉर्टेंट है, ऐसी सेट बी भी इंपॉर्टेंट है। अब आप आपकी जो केस स्टडी है वो कंपनी कंपनी के ऊपर बेस्ड है, और जो जितनी भी कंपनी है, अब वहां पे जो लॉ लॉ का सब्जेक्ट है उसकी कनेक्टिविटी इजीली हो जाती है अगर कोई कंपनी मतलब कोई कंपनी है तो कंपनीज के केस में कॉर्पोरेट गवर्नेंस बहुत बहुत इंपॉर्टेंट है। जैसे डायरेक्टर्स आप देख लीजिए, डायरेक्ट आप पिछले 3 अटेम्प्ट का ट्रेंड देख लीजिए, वहां से क्वेश्चन आ ही रहा है कि जैसे डायरेक्टर अपॉइंटमेंट से आ गया, डायरेक्टर्स रेमुनरेशन से आ गया। हर एक कंपनी तो इंसॉल्वेंसी में नहीं जा रही है आपकी, लेकिन हर एक कंपनी के ऊपर कॉर्पोरेट गवर्नेंस अप्लाई भी हो रहा है। और साथ में आप ये भी देखिएगा कि लिस्टेड जो कंपनी है, अगर लिस्टेड हो गई तो कंपनी सेबी एलओडीआर का क्वेश्चन बनने के पूरे चांस हो गए। इसी तरीके से ये जो फोरेक्स का चैप्टर है, फोरेक्स का चैप्टर कहां पे? फाइनेंस में। ठीक है, वो कहीं भी कनेक्ट हो जाता है। क्यों? क्योंकि कोई भी कंपनी है उसका फॉरेन ऑपरेशन हो सकता है या कहीं से भी फोरेक्स जो है, तो वहां पे क्या है कि फॉरेन एक्सचेंज से, हेजिंग से रिलेटेड क्वेश्चंस इजीली कनेक्ट होके आ सकता है। आपके पिछले 2-3 अटेम्प्ट के आप एग्जामिनेशन में देखिए। तो इसलिए आप इस थिंकिंग से अपनी प्रिपरेशन कीजिए, ठीक है। और सिमिलरली अगर फॉरेक्स इन्वॉल्व हो गया तो ये आपका फेमा, फेरा, ये भी एप्लीकेबल हो गए। तो इसलिए ये आपको प्रॉपर प्लानिंग से आपको स्टडी करना है इस पेपर को। इसमें कुछ नहीं है, अगर आपने दूसरे सब्जेक्ट्स को ढंग से पढ़ा हुआ है, कॉन्सेप्चुअल अंडरस्टैंडिंग है, मैं ये नहीं कह रहा कि आपको डिटेल में, अगर आपको बेसिक कॉन्सेप्चुअल अंडरस्टैंडिंग भी है, इस पेपर को आप इजीली क्लियर कर लोगे, ठीक है। और फेमा के कंप्लायंसेस भी कनेक्ट हो गए। तो ये आपको सिखाता है, जो कि रियल में अभी जुलाई को, तो इसके अंदर अब आप देखेंगे काफी सारी केस स्टडी ऐसी हैं जो कि रियल में है, वो कंपनियां रियल में एग्जिस्ट करती हैं, ठीक है। तो आप सोचो कि किस तरीके से एनुअल रिपोर्ट के अंदर जो है, मतलब किस तरीके से वो एनुअल रिपोर्ट के एक्सट्रैक्ट्स आपकी केस स्टडी के साथ कनेक्ट हुए हैं, आप उनको देखो किस तरीके से हैं। लेकिन अगर आपने एनुअल रिपोर्ट खोल के देखी होगी तो आप इजीली कोरिलेट कर लोगे। आप देखो कि किस तरीके से डोरमेटो वाली केस स्टडी में जो लास्ट में जो एक्सट्रैक्ट है वो रियल लाइफ में हुआ है। तो इसलिए इस सब्जेक्ट को सिंपली आपको स्टडी करना है, केस स्टडीज को, और सब्जेक्ट्स की बेसिक कॉन्सेप्चुअल अंडरस्टैंडिंग आपकी होनी चाहिए, ठीक है। हाँ, तो अब मैं आपको बता रहा था कि रिक्वायरमेंट पढ़ा, फिर हमने रिक्वायरमेंट पढ़ते पढ़ते हमें पता लगा कि एक रिक्वायरमेंट पढ़ने के बाद हमने अब जब केस स्टडी पढ़ना शुरू किया तो अब हमने उसका एक स्केच स्केच बनाना शुरू किया। जैसे जैसे हम अब सपोज क्वेश्चन के अंदर है कि कि असेस कॉम्पिटिटिव एनवायरनमेंट, और हमें पता है पोर्टर 5 फोर्सेस लगना है। तो जैसे ही मैं केस स्टडी को पढ़ना शुरू करूंगा और पढ़ते पढ़ते जो पोर्टर 5 फोर्सेस से कनेक्टेड जो भी पॉइंट्स आए उनको अपने ड्राफ्ट स्केच के अंदर लिख लो, ठीक है। जैसे ही आपने लिखा, ठीक है, लिखते लिखते आपको आपका इसी तरीके से, जैसे ही अगर कोई इंडिया सप्लाई हो रहा है तो उससे रिलेटेड सारे पॉइंट्स लिख लो, या टैक्सेशन से रिलेटेड कोई रिलीवेंट कॉन्सेप्ट लग रही है, अगर 35 एडी से रिलेटेड लग रही है, 115 जेबी से रिलेटेड कुछ, अगर आपको कुछ मटेरियल चीज मिल गई तो उसको नोट डाउन कर लो, या पेपर के अंदर अंडरलाइन कर लो। क्यों? क्योंकि ये एक तरीके से आपका बेस बन गया, आपको रिक्वायरमेंट भी पता है, आपको ये भी पता लग गया कि केस स्टडी के अंदर क्या है। बस अब आपको उसको कनेक्ट करना है कॉन्सेप्ट के साथ और फाइनल आंसर को लिखना है। और कॉन्सेप्ट के साथ कनेक्ट तभी कर पाओगे जब जो मॉड्यूल है ना आपका, जो आपका मॉड्यूल है, उससे आपने उसको आप उस मॉड्यूल को आपने पहले से पढ़ा हुआ होगा, उसकी बेसिक अंडरस्टैंडिंग होगी। तो इस तरीके से आप केस स्टडी का आंसर ड्राफ्ट करेंगे, ठीक है। ये नहीं कि अननेसेसरी थ्योरी कुछ भी उठा के लिख दिया, नहीं। जो क्वेश्चन की रिक्वायरमेंट है आपने उसको फॉलो करना है, उसको आपने लिखना है, ठीक है। अब हमने केस स्टडी का आंसर भी ड्राफ्ट कर लिया। उसके बाद देखना है कि एमसीक्यू, एमसीक्यू भी बहुत इंपॉर्टेंट है, कि एमसीक्यू में मोस्ट लाइकली, ठीक है, नॉट एमसीक्यू, ठीक है। ये सारे जो है, ये सारी चीजें आपने ध्यान में रखनी है, ठीक है। और जो इस पेपर को कॉन्फिडेंस के साथ देने के लिए जाओ, ठीक है। अगर कॉन्सेप्चुअल अंडरस्टैंडिंग आप की है तो आप अच्छा स्कोर करोगे करोगे, ठीक है। और हमारी साइड से आपके लिए पूरा पूरा सपोर्ट है। अगर और कोई क्वेरी है स्टूडेंट्स if you have any other query, you may ask. Otherwise, I am winding up this session. Okay. As we conclude this enriching session, we extend our heartfelt gratitude to CA Sujana Balaji for graciously sharing her time, knowledge, and valuable insight with us today. Your analysis beautifully highlighted how regulatory framework, financial reporting standards, tax provisions, and strategic planning must work in tandem for organizations aiming to grow sustainably and responsibly. Thank you once again for your thoughtful and engaging session. To all our students who joined us, thank you for your energy, participation. So keep exploring, keep questioning, and most importantly, keep practicing. Wishing you all the best for your preparation. And once again, a sincere thank you to everyone for making today's session a success. Thank you, students. Thank you so much. Yes.